So now let's get started with the revision of the fourth chapter of this marathon, which is investment decisions. And this chapter is also popularly known as capital budgeting. Capital budgeting. See, it is mentioned here. This chapter is also popularly known as capital budgeting. Now, first, let us understand this chapter with a background. This is a very easy chapter if you understand the logic, number one. And number two, there could be some case study questions in this chapter, which students generally find it difficult. So I am also going to solve two extra case study questions in this marathon itself in order to give you a proper clarity. Now, in case of case study questions, what you need to do is you need to have patience in reading the question carefully. And once you read this question carefully, automatically you will know how to proceed further. Clear? Yes. So now first, this chapter is called as investment decision. The alternative name for this chapter is also known as capital budgeting. Now, what does this chapter talk about? Now, in our subject, financial management, yes, we saw that overall financial management helps us achieve three objectives: financing decisions, that is decisions relating to fundraising activity, correct? Then investment decisions, that is decisions relating to where the funds should be deployed, correct? And then you have something called as dividend decisions, right? So under financing decisions, we saw three chapters we saw already. So the three chapters that we saw already was cost of capital, then we saw leverages, then we also saw capital structure decisions, correct? Yes. So now this chapter, the name itself is investment decisions. This falls under the category of the second objective of our subject, which is investment decisions. Sir, what do you mean by investment decisions? So where exactly does this fit into? And in financial management, what we are going to do in this particular chapter? Now, let's assume this is the balance sheet of a company, right? Now, what happens to actually start a business? Company needs money, correct? So company can get money from various sources of finance, as we have seen in the previous chapters. It can be through equity share capital, it can be through retained earnings, your preference share capital, your debentures, your long-term loans, etc. Correct? So now a company raises money from these different sources of finance. Obviously, each source of finance has its own cost, and the weighted average cost of capital is popularly known as the overall cost of capital, or WACC. So basically, the company raises money, correct, which comes with a cost. Now, why does this company raise funds? So that they can deploy this funds, they can put this funds into the business and generate some revenue. Sir, what is the meaning of this? Basically what they do is, once they raise this money, the company will predominantly buy fixed assets, correct or not? Yes, using this fixed assets like plant and machinery, your entire factory, or it can be your equipments, it can be so many things. Using this, of course, in your day-to-day operations, you have something called as current assets, current liabilities. You have current assets here, current liabilities here. Popularly, these two netted off is called as working capital. This working capital is a subject matter of study in the next chapter that we are going to revise, which is working capital management. But the predominant amount of the long-term sources of finance goes into the company's non-current assets, also known popularly called as fixed assets. Why? Only if you have a fixed asset, only if you have a factory, only if you have equipments and all purchased, only then you can run your day-to-day operations. Yes or no? So the next part of this particular financial management is, which are the assets I need to buy? Or in other words, taking decisions with respect to the investment perspective. Sir, what could be the decisions that I take in this chapter? Let's say I'm a manufacturer. Let's say I'm a pen manufacturer. Okay. Now, this pen, whatever pen that I'm going to manufacture, let's say I'm Rorito, right? This company called Rorito. So let's say I'm a pen manufacturer. This Rorito pens can be manufactured using machine 1 or machine 2 or machine 3. Let's say there are three models of machines available, correct? Now, whether I should buy machine 1 or I should buy machine 2 or I should buy machine 3, this is a decision taken in this chapter. This is one of the decisions. Are you clear with this? So it is not necessary that, one second. So it is not necessary that this is the only decision that you are going to take. It can be machines in this case. It could also be projects. What do you mean by project? Let us say I am a company like L&T. Okay, I'm a company like L&T. So whether I should go for project A or project B or project C, or maybe project A and B together, or B and C. So whichever ways. So I need to find out where this money needs to be deployed, because I am raising this funds. These funds do not come free of cost. It comes with a cost. Yes, now I should judiciously, I should carefully invest it in such avenues that gives me more return. So I will have to compare between different alternatives. Are you clear with this? Yes. Now, sir, how do we go about with this chapter? There is something called as capital budgeting techniques in this chapter. We will be seeing, using those techniques, we will actually gauge, we will find out which is the best investment proposal, and all those things related to that we will find out. Now, one most important thing in this chapter is about cash flows. That is, let us say, if I want to purchase machine 1, now initially there will be year 0, there will be a cash outflow, correct? Let us say 100 crores is the cash outflow, correct? Then let us say this machine has a life of 5 years. So for the next 5 years, the machine can generate what? Inflows. So it can generate, let us say, 30 crores in year 1, 25 crores in year 2, 15 crores in year 3, 10 crores in year 4, and let us say 12 crores in year 5, and so on. Are you clear with this? So always remember, in this chapter, in investment decision chapters, there is an initial outflow followed by a series of cash inflow. Why? Because first you need to shell out money to buy the fixed asset, to buy the long-term equipment, correct? And once you do that, you can use it every year. To generate your cash flows. Are you clear with this? This is exactly the opposite of cost of capital. There in cost of capital, what we saw, it is about fundraising activity. Initially, you will get the funds from the investor, followed by a series of outflow. Every year, you need to pay them interest or dividend, correct? But in this case, what happens? The cash flows are reverse. Exactly. That is initially there will be an outflow followed by a series of inflow. Are you clear with this? That is how this entire chapter is going to look like. And of course, we will be using time value of money techniques and all that. But remember, this chapter is about what? About where should I park my funds? Which are the right avenues where I can invest my funds and generate money? Are you clear with this? Yes. Now, there are some popular capital budgeting techniques. So this is the overview of this entire chapter, capital budgeting techniques. So capital budgeting techniques can be broadly classified into traditional or non-discounting techniques and time adjusted or discounted techniques. Are you clear with this? Very simple. There are only two methods in the traditional technique, something called as payback period and something called as accounting rate of return, right? And then there are 5 methods under the time adjusted or discounted techniques, something called as NPV, which we've already seen in basic concepts, correct? What do you mean by net present value? The present value of cash inflows minus present value of cash outflow. Are you clear with this? Then there is something called as profitability index. Profitability index is nothing but present value of cash inflows divided by present value of cash outflows. Are you clear with this? This is what NPV, present value of cash inflows minus present value of cash outflow, correct? So if the NPV is positive, then it means that you can go for the project. If NPV is negative, it means that you should not go for that particular investment avenue. Are you clear with this? Fine, I'm just giving you a broad introduction. Anyways, we will be seeing a lot of sums, even high level sums we'll be seeing, so we need not worry about that. Whereas profitability index means what? Present value of cash inflows divided by present value of cash outflows. So technically, if the numerator is greater than the denominator, that is, if your present value of cash inflows is greater than your present value of cash outflows, generally your profitability index will be 1, correct? If it is less, if your present value of cash inflows is less than your present value of cash outflow, then it means that your profitability index will be less than 1. It will be in a decimal. Are you clear with this? So ideally, if your profitability index is 1 or more, then technically it means that you have a positive NPV. This is some interconnection that we can do. Then we have IRR. internal rate of return. So what do you mean by internal rate of return? The rate that makes our NPV equal to 0, or in other words, the rate that makes my present value of cash inflow equal to my present value of cash outflow. That is the rate that makes my NPV equal to 0. We have already seen this in the basic concepts. Anyways, we'll be touching upon this. Then there is something called as discounted payback period, and the final thing is called as MIRR, marginal internal rate of return. It's a modified internal rate of return. It's a modification of IRR. Are you clear with this? Now, very simple. The first two methods, traditional methods, these two methods ignores the concept of time value of money. Clear? Whereas these five methods considers the concept of time value of money. So you tell me logically which is better, the traditional approach or the time adjusted approach? Obviously the time adjusted approach. Why? Because the time value of money concepts are considered here only in the traditional approach, that is the payback period and accounting rate of return. Generally you don't consider your time value of money concept. So basically it is not that great approaches. Are you clear with this, sir? So we are finished the chapter? No, I'm just giving you an introduction. So we will be seeing everything one by one with numerical problems. Are you clear with this? Yes. Now there are a few rules, general rules that we need to follow in this particular chapter. So I told you, right? So generally in this investment decisions, there will be a cash outflow initially, followed by series of cash inflows. Correct? Yes. Now every year you have a cash inflow. Correct? The cash flow is there. Correct? Now what cash flow is this? Or in other words, what are the items that needs to be considered while arriving at this cash flow, every year's cash flow? What are all the items that needs to be considered? These are some general rules that is prescribed at the beginning of this chapter. All these things are mentioned in our ICA study material. Now, while calculating the cash flows in capital budgeting decisions, the following items need consideration. The first one is depreciation. Now, depreciation is a non-cash item by itself. It does not affect the cash flow. However, we must consider the tax shield or tax benefit from depreciation in our analysis. Since this benefit reduces the cash outflow for taxes, it is considered as a cash inflow. So what do you mean by this? Now, let us say every year you have all the cash flows, correct? In that, depreciation is also one expense. So in your P&L account, if you see, you have sales, correct, minus all your operating expenses and all you have, minus depreciation is also an item, correct? You arrive at this to compute at your profit before tax. Yes or no? Fine. From this you reduce your tax to arrive at your profit after tax. Yes. Now you tell me, now this depreciation is no doubt an expense considered for the purpose of arriving at your profit after tax. But you tell me, from a cash flow perspective, every year will you pay depreciation to anyone? No, it is not a cash outflow. But the presence of depreciation can reduce your tax liability. Why? Because depreciation is a tax allowable, tax deductible expense. So, or in other words, depreciation as such should not be considered, but the presence of depreciation will impact your tax savings, correct or not? Or in other words, the tax savings on depreciation should be considered, but depreciation as a whole should not be considered. Sir, can you give us an example? Let us take the first question in this particular discussion, in this particular chapter. Let's take the first question. So go to question number 1. ABC Limited is evaluating purchase of a new machinery with a depreciable base of 1 lakh rupees, expected economic life of 4 years, and the change in the earnings before taxes and depreciation of 45,000 in year 1, 30,000 in year 2, 25,000 in year 3, and 35,000 in year 4. Assume straight line method of depreciation and a 20% tax rate. You are required to compute the relevant cash flows. So now what they are saying, if this company ABC Limited, if they buy a new machinery, for the next 4 years, it has a useful life. And for each of the 4 years, they have given the earnings before tax and depreciation. That is earnings before tax and depreciation. Tax and depreciation both have not been considered, so which means they are yet to be considered. How much? 45, 30, 25 and 35. This is what they have given. Now, what we need to calculate in this question, we just need to calculate the cash inflows for these 4 years. Are you clear with this? That's all. we are not using any capital budgeting techniques and all, we are not applying. They have just asked us to calculate the cash flows for each of these 4 years. Now, they have given that the depreciable base is how much? 1 lakh rupees, and straight line method of depreciation, tax rate is 20%. Straight line SLM method of depreciation, which means 1 lakh divided by 4. Every year the depreciation is how much? 25,000 rupees. So what we need to do, earnings before tax and depreciation less depreciation. So in the first year it will be how much? 45,000 minus 25,000. It gives you earnings before depreciation of how much? Earnings before tax of how much? 20,000, correct? Minus tax at the rate of 20% gives you how much? 4,000 rupees of tax. So earnings after tax is how much? 16,000. Now wait. This 16,000 is not the cash flows after tax. Why? Because this depreciation ideally was not a cash flow out at all. It was not a cash outflow, but I have subtracted it. Correct? So now what we need to do is, whatever depreciation we subtracted before, now we need to add it back. So add back depreciation. Why? Because it was never an outflow. I have subtracted it before, so now I am adding it back. So the net cash flow after tax is going to be 41,000. This is the amount that is considered for all our investment decision purposes. Are you clear with this? So whenever I say the relevant cash inflows, it is basically cash flows after tax. Are you clear with this? Remember this word, cash flows after tax. That is, we are considering only cash flows, that too after tax, the post-tax cash flows. Now, I'm repeating this entire thing once again. We started with where? Earnings before tax and depreciation. We subtract depreciation, arrive at earnings before tax. Always remember, earnings before tax is the base on which the tax rate is applied. Correct? So, less taxes, you get earnings after tax. Correct? Now wait, since depreciation was a non-cash item, still it was subtracted. So now you add it back to nullify the effect. You get this cash flows after tax. Are you clear with this? Now you might have a doubt. Sir, I have subtracted depreciation here, but I have added it back here. Instead, I could have ignored depreciation completely. No. Just look at this. I subtracted depreciation here and added it here. In between, there is a line item called tax. Correct? Now, tax is calculated on earnings before tax, or in other words, since the depreciation was initially subtracted, the base on which I am computing the income tax is now reduced. So instead of calculating tax on 45,000, I am calculating it on 45 minus 25, only 20,000, correct? So, or in other words, because of the presence of depreciation, what has happened? Your tax outflow has reduced. So technically what we have done is, we have ignored this depreciation as a whole, but the presence of depreciation has impacted on some tax savings. So the tax shield on depreciation has been properly considered. How? Because we have reduced it in the beginning, and on that reduced amount only we have computed the tax, and then we have added it back once again. Are you clear with this? Are you clear with this? This is how you compute the relevant cash flows for every year. Similarly, for second year, earnings before tax and depreciation, subtract depreciation, you get earnings before tax, multiply the tax rate on that, you will get earnings after tax, then add back your depreciation, you get your cash flows after tax. Similarly for third and the fourth years respectively. So now every year's cash flow is how much? Net cash inflow that you get is how much? So if you invest in this machinery, at the end of year 1, technically you get 41,000 after paying all the taxes, correct? Here, at the end of year 2, 29,000. At the end of year 3, 25,000. And at the end of year 4, it's going to be 33,000. Remember, here in this chapter, we are talking about cash flows. We are not talking about profits. We are only talking about cash inflows and outflows. We are just matching these two, cash inflows with cash outflows. We are not bothered about the profits and all that. So based on the data that is given, based on the starting point, what we need to do, we need to arrive at what? The cash flows after tax. Are you clear with this? So earnings before tax and depreciation minus tax gives you earnings before tax, correct? Less taxes gives you earnings after tax. But now you need to add back the depreciation which we once subtracted. So you'll get the cash flows after tax. And the relevant criteria for this chapter is cash flows after tax. Are you clear with this? So basically, in short, we need to ignore. So depreciation should not be subtracted, but tax saving on depreciation should be considered. That's why we subtract it on the top and compute the tax. And finally, at the bottom, once again, we add it back. So that overall, what happens? Only the tax impact or the tax savings on the depreciation is being considered, whereas the whole depreciation as such is not being considered. Are you clear with this? This is the first learning here. Right. Now, now go back to the first one. Go back to the first one. These are some basic rules. The problem is students generally they miss out on this very basic areas, because if you spend more time on this and learn this basic areas, automatically any kind of sum you will have a crystal clear clarity. Clear. So generally students miss out on this, and that is the reason why I'm just quickly going through this. Next, B, determining the discount rate. Now I told you this chapter involves what? Time value of money techniques. Yes. So not considering time value of money techniques, there are only two methods. Leave that. But predominant portion of this chapter considers time value of money techniques. Yes. Now this 100 crores is a cash outflow arising at the beginning of the life of the project, that is on the present date. But if you see, this 30 crores is happening at the end of year 1, 25 crores the end of year 2, 15 crores the end of year 3, 10 crores the end of year 4, and 12 crores the end of year 5. Correct? So these are cash flows, cash inflows arising at different point of time. Yes. Now can I add these cash flows as such? No, I cannot add these cash flows as such. Why? Time value of money concept, because the cash flow at the end of year 1 and cash flow at the end of year 2, or the cash flow at the end of a different period, are not comparable as such. So what will I have to use? I need to use a relevant discount rate and convert all these things into present value and arrive at the present value of cash flows. Yes. Now for me to do it, for me to actually arrive at the present value, how will you do it? Very simple. Cash flow at the end of year 1 divided by 1 plus r to the power 1 plus cash flow at the end of year 2 divided by 1 plus r the whole power 2 plus cash flow at the end of year 3 divided by 1 plus r the whole power 3 plus cash flow at the end of year 4 divided by 1 plus r to the power 4 plus cash flow at the end of year 5 divided by 1 plus r to the power 5. Correct? If I do this only, I will get the present value of cash inflows, because these cash flows are not addable as such. Correct? Now here basically we need a discount rate. Yes or no? We need a discount rate. Yes. What is the discount rate that we can consider here? Now very simple, guys. This is where we are going to connect the concept. This discount rate that we will be considering in this chapter is nothing but your WACC, weighted average cost of capital, also known as KO. Are you clear with this? Sir, why, sir, in this chapter we are taking the discount rate as weighted average cost of capital? Very simple. Look at this. I am raising funds. Correct? The cost of raising the funds is only called as KO, also known as weighted average cost of capital. Correct? Now, when I am taking an investment decision, let us say the weighted average cost of capital is, example, 12%. Correct? Now, when I'm taking an investment decisions, I should invest in the machines, or I should invest in assets that at least generates how much? 12% return. Only then I will be able to pay my finance cost. Correct or not? Yes. So technically, this is the base on which I will do all the computations, or this is the minimum rate that I need to generate using my assets. Are you clear with this? So whenever they are asking for a discount rate in this chapter, discount rate stands for KO, also known as weighted average cost of capital. And this is the logic. An organization may establish a minimum rate of return that all the capital projects must meet. This minimum could be based on an industry average or the cost of other investment opportunities. Many organizations choose to use the overall cost of capital, or WACC, weighted average cost of capital, that an organization has incurred in raising funds or expects to incur in raising the funds. Are you clear with this? This is what they are saying. So which means discount rate stands for what? Discount rate stands for your weighted average cost of capital. Now, this is different from IRR concept. I will come to that in a while. Next, exclusion of financing cost. Now, very important. Now, what we do? So the present value of cash inflows, present value of cash flows, whatever you want, you can just say. Now, what we do? The relevant cash flows divided by 1 plus r to the power n. Yes or no? This is how we need to discount the cash flows. Yes. Now, what they are saying, this relevant cash flows are nothing but cash flows after tax. Correct? Yes. The first thing we saw is depreciation should not be considered, but the tax impact on depreciation should be considered. We have seen it. Yes, absolutely. Right? Now, this is always post-tax. Taxes should be considered. After tax, cash flows should only be considered. Yes. Now, one very important thing that we are going to see, while computing the relevant cash flows, that is the numerator, every year's cash inflows while you are computing, you should not deduct any kind of finance cost. What do you mean by finance cost? Basically interest and dividend. So what is this, sir? What is the logic for this? I will explain. So what we are saying, every year the cash flows after tax that we are computing, it should not consider the finance cost. Why, sir? Is this as operating cost? No, 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 no. That is not the reason. I will give you the logic. The finance costs are already considered while computing the denominator. What is denominator? R. R is nothing but KO, no? Yes. What do you mean by KO? What do you mean by KO? So KE into WE plus KP into WP plus KD into WD. Yes, this is how you compute, correct? While each of these costs are already considered in the denominator, if you consider it once again in the numerator, if you deduct all these things once again in the numerator, it will definitely have a double negative impact. So you should not do that. Or in other words, this numerator should be the funds available, or the net cash flows available for distribution to all the sources of finance. Are you clear with this? That logic you remember. So basically this cash flows after tax should be after tax, but before paying your interest and dividend, before finance cost. Why? Because all your finance related costs are being factored into in your denominator, and in the numerator you should only consider the cash flows that are available for all the sources of finance. Are you clear with this? This is the logic for taking up cash flows after tax without considering the finance cost. Very important thing, guys. These are some fine things that students generally miss in exam. That's why I'm pointing it out for you. Exclusion of financing cost. So when cash flows related to long-term funds are being defined, finance cost of long-term funds, that is interest or dividend, should be excluded from the analysis. See, these are reflected in the weighted average cost of capital. Look, all these words are coming from institute study material. Correct. Hence, if the interest on long-term debt and dividend on equity capital are deducted and defined in the cash flows, the cost of long-term funds will be counted twice. So these things are already taken care of in the denominator. Please don't disturb the numerator once again. That is, don't consider all these while taking up the cash flows. And post-tax principle, we already saw. That is, we are only talking about cash flows after tax. Correct. So the relevant cash inflows while you're computing, you should compute the cash flows after tax and not the cash flow before tax, only after tax. Fine. And similarly, in the denominator, while computing 1 plus R, that R is nothing but your weighted average cost of capital. Correct. And weighted average cost of capital is nothing but KO. For calculating KO, you consider all taxes and all. What do you mean by KD? How do you calculate KD? For KD calculation itself, I into 1 minus T and all we do. So basically the denominator also considers, it is also the post-tax cost of capital. The numerator is also your post-tax cash flows only then it is comparable. Are you clear with this? Have these crystal clear clarity. So the cash flows after tax should not consider depreciation, but it should consider the tax shield on depreciation. So you subtract it once and then add it back in the end. Correct. The second point that we studied is what is the discount rate. Discount rate is taken as the weighted average cost of capital. The third point that we studied here is the financing cost should not be considered, should not be deducted from your numerator. Reason, the logic is nothing but it is considered while calculating your discount rate. And the fourth one is always the cash flows that you consider should be post-tax cash flows. Are you clear with this? These are some basic ground rules on which this entire chapter is being based about. So now we have seen how to calculate the cash flows and all that. Now let's quickly jump into the capital budgeting techniques. So what do you mean by capital budgeting techniques? These are the techniques using which you will judge whether you should go for a particular project or not. Are you clear with this? So these are the techniques or methods using which, the tools using which you will judge whether you can go for a particular investment avenue or not. Project A, if you can go for it or not. How it is what we are going to see. Now, traditional method has two things. One is called as payback period. The other one is called as accounting rate of return. So payback period and accounting rate of return. These are the two traditional approaches. Nothing great here. Nothing great here. So accounting rate of return. So the accounting rate of return of an investment measures the average annual net income of the project, that is incremental income, as a percentage of investment. Now, what it is, I will just tell you. We will do an example and we will just finish it off. Very simple, But remember one thing, these are what? These two methods, that is payback period and your accounting rate of return, ignores time value of money concepts. Hence, in this case, in this accounting rate of return that we are going to see, we will not be talking about cash flows. We will be talking about profits. Accounting rate of returns, we are going to talk about profits. This is the only method where we will be talking about profits. Sir, you just now you said cash flow should only be considered, your profit should not be considered. Correct. Yes, this is a method which ignores your time value of money. So for this method alone, you should consider only your profits. What it is and all, I will just walk you through. Don't worry about it. So let's go to the second question, which is problem number 2, average rate of return, accounting rate of return. Basically, it can be called as anyways. A project requiring an investment of 10 lakh rupees and it yields profit after tax and depreciation as follows. Look, they are not mentioning cash flow. They are mentioning profit after tax and depreciation. Year 1, 50,000, year 2, 75, year 3, 125, year 4 is 130, and year 5 is 80,000. So if you add up all these things, the total cash flow is how much? 4,60,000. Wait, so just now you said the cash flows arising at different periods cannot be added as such. Yes, if you follow time value of money techniques. That's why I said these methods are not great. They don't follow time value of money techniques. That's why they have added all these things. Are you clear with this? Yes. Now, suppose further that at the end of the 5th year, the plant and machinery of the project can be sold for 80,000 rupees. Determine the average rate of return. They are asking us to calculate average rate of return. Guys, nothing. This is plain vanilla. This is nothing great there in this particular question. This is looking at things from an accounting perspective. So technically, this is not even related to finance. I would say this is an accounting perspective. It is about calculating average rate of profit. That's about it. It's nothing to do with, I would say nothing much to do with finance. What it is, how to calculate. Now, the rate of return can be calculated as follows. Basically, the reason why I'm doing this is there are 2 ways in which you can compute the average rate of return. The first one is what? The numerator should have what? Average profits. Numerator should have average profits. Denominator should have what? Investments, correct? Average profit, how will you compute? Very simple. Sum total of all the 5 years profits divided by 5, correct or not? Yes. So sum total of all 5 years profit is how much? 4,60,000 divided by 5. How much is this? 92,000, correct? The denominator should have investment, correct? Now, the question here generally is, should I take average investment or should I take initial investment? Now, in this method, in this ARR method, you can either take initial investment or you can take average investment. But this sum, we will do it under both. That is, denominator alone, there is a confusion. So first, if the initial investment is taken, very simple. So what is the numerator? Average profit. Average profit is nothing but total profit for all the 5 years divided by 5 years, correct? 460 divided by 5 divided by initial investment. What is your initial investment? So it's 10 lakh rupees. Are you clear with this? So divided by 10 lakhs. So it gives you 9.2%. Are you clear with this? So we can say if you invest this, if you invest money, if you park your funds in this project, you get an average rate of return of how much? 9.2%. Now this rate is compared with the rate expected on other products. Suppose the company has a policy. I will invest in a project only if it at least generates me 10% of return. Now this, they will have a yardstick, correct? This project gives me only 9.2%, so rejected. Don't go for this project. Are you clear with this? So these can be used as a yardstick to judge whether or not to go for this particular project. This 10%, how they arrive, they can use it as any parameter, or they can even keep the WACC, weighted average cost of capital. Let's say weighted average cost of capital for this company is 10%, which means if they are deploying their funds, every rupee that they are investing in a project should at least get them 10% or more, correct? Because anyways, I need to pay 10% for every rupee that I have borrowed, source of finance. So when I'm investing it, it should generate at least 10%. This project generates only 9.2%. So now I will not go for it. Are you clear? Suppose the weighted average cost of capital is only 8%. This project generates 9.2%. So yes, since the return that I get from this project is more than my weighted average cost of capital, then the company can decide whether to go for it or not. Are you clear? It is feasible. It's at least an open option that you can keep. Clear? Fine. For example, the management may decide that they will not undertake any project which has an average annual yield after tax less than 20%. Any capital expenditure proposal which has an average annual yield of less than 20% will be automatically rejected. This 20% and all is just a yardstick example that they have mentioned. Don't think always 20% is a yardstick. No, nothing of that sort. Now, This ARR can be also calculated using a different formula. Average profit divided by average investment, correct? This is where many students have a doubt regarding the formula that the institute has given in the study material. Average investment is equal to 1 by 2 into initial investment minus salvage value. So half of initial investment minus salvage value plus salvage value. So why this formula? Look guys, it's very, very simple. Don't complicate it. Don't complicate it. Now, if I split and write this formula, automatically you will understand this is nothing. Average investment means what? Opening plus closing divided by 2, or half of opening plus closing investment. Correct or not? Yes? Right. Now you tell me, this formula they have given, let us just split it and write. Can I rewrite this formula as half of initial investment, I'm writing it as II, minus half of salvage value, correct? So half into initial investment minus half into salvage value plus salvage value, correct guys? Yes. So can I say salvage value minus half of salvage value? Can I say, if I block these two together, can I say salvage value, 1 salvage value minus 1 by 2 of salvage value is nothing but 1 by 2 salvage value, correct guys? Yes. Salvage value minus half of salvage value gives me what? Salvage value, that is plus half of salvage value. 1 minus 1 by 2 gives me plus 1 by 2, correct? This is nothing but 1 by 2 of initial investment. Or in other words, can I say this is nothing but this formula is nothing but half of initial investment plus salvage value, correct? That is nothing but, if you see in your capital employed and all, you would have seen in your accounts, average capital employed is opening plus closing by 2. This is also the same formula only, but they have just rewritten it like this: half of initial investment minus salvage value plus salvage value. Very simple. So half of salvage minus half of salvage value plus salvage value is nothing but half of salvage value, correct? So half of total investment plus half of salvage value, this is the formula that you get, that is half of initial investment plus salvage value. In this case, you tell me, what is the initial investment? 10 lakhs, correct? What is the salvage value? 80,000. 10 lakhs is the initial investment, 80,000 is the salvage value. Average of this is how much? 10 lakh plus 80,000 divided by 2. Half of this is going to be 5,40,000. That is exactly what you get here. 5,40,000 is exactly what you get here, even if you use this formula. So don't complicate it by yourself. This is nothing. In fact, this is nothing. This is average in investment and all. They have just ignored the time value of money concepts and they have done it. This is nothing but opening plus salvage value divided by 2. That is opening investment plus closing investment divided by 2. They have rewritten it like this. So in exam, can I write this formula, whatever you have mentioned? No. Please write it exactly like this. The logic, you remember it as this. Are you clear with this? Because I don't want to take any chances. This logic and all is not mentioned in the study material. I'm giving it to you. Clear? So if at all you find it difficult to remember this formula, it's very simple. Half of initial investment minus salvage value plus salvage value. If you just split and write it, you will get half of initial investment plus salvage value. That's about it, guys. Are you clear with this? So the denominator can be 5,40,000. So if this changes, obviously the answer will also change. So if you use this method, your average rate of return is going to be 17.04%. Now, sir, should I take 9.2% or 17.04%? It depends on the company. Whichever method they want to take, they can take. In exam, if the question is silent, you can take either any of the method, or if this is a 5-mark question they are asking, you better do both the methods and leave it there. Are you clear with this? That's about it. Beyond this, there is no much of relevance in this area because it ignores all the time value of money concepts, and it does basically they are calculating the average rate of return. That is average profit divided by investment. Numerator, no problem. Average profit is total profits for all the 5 years divided by 5 years. Denominator is, should you take the initial investment alone or should you take the average investment? If you take the average investment, it is nothing but half of initial investment plus salvage value. Or if you want to write it in institute's language, should write 1 by 2 the whole into initial investment minus salvage value, bracket close, plus salvage value, net off, it gives the same result. Are you clear with this? With this, we are done with this. And this ARR, average rate of return, whatever you get, you will compare with the minimum expected return. If the average rate of return is more than the minimum expected return, go for the project, else you don't go for it. As simple as that. This is the decision criteria. Are you clear with this, guys? Yes. So now you just go here and just read it. accounting rate of return, what is the decision rule? A project with a high ARR is generally accepted. So let's say there are project A, project B, project C. I have 3 projects. I need to choose between one project. Now, whichever project has the higher ARR, I will go for that project. So if you are deciding, if your investment decision is based on ARR, then you will go for that project which has a higher ARR. Are you clear with this? That is how it should be interpreted. Next, payback period. Now let's directly jump into the question and see what it is. What do you mean by a payback period? The time required to recover the initial cash outflow is called as payback period. Are you clear with this? Are you clear with this? So a project with a lower payback period is generally preferred. Sir, can you give us an example? Yes, let's go to this question. We will automatically see what it is. Very, very simple, guys. Understand things logically. Please don't ever mug it up. It's very, very simple. Now let's go to the third question. Now, calculate the payback period and discounted payback period for a project with 30,000 rupees of cash outlay and annual cash inflows of 6,000 for a period of 10 years. The discount rate is 15%. Now. Payback period is under the traditional approach, correct? Discounted payback period comes under the discounted approach. That is, if you see, there are 2 methods, correct? These are 2 different methods. If you see in the chart at the beginning, if you see payback period comes under traditional or non-discounting model under the initial phase. Then there is also something called as discounted payback period that comes under what? Discounted cash flow model. Are you clear with this? So we are going to see both. We are going to see both these methods. Now first let us see what is payback period. Related to this is only discounted payback period. That is exactly same as payback period, but in discounted payback period you consider the time value of money concept. That's about it. What it is we will see right now. Now look at this. Now what they are mentioning. Now, a project requires an initial outflow of how much? 30,000 rupees, correct? Now, let me just put it here. This project requires an initial outflow of how much? This project requires an initial outflow of, so the cash outflow is going to be how much? 30,000 rupees. And what have they mentioned? If you invest this 30,000 rupees every year, let's say I'm investing 30,000 rupees in purchasing this machine. Every year using this machine, yes, I will generate sales. I will also have my cost. So sales minus all the costs. So the cash flows after tax, that is depreciation, adding back all these adjustments. If you see, the net cash inflow that I get after all my expenses is 6,000 for a period of 10 years, right? So basically what they are saying, if you invest this, then for the next 10 years, 1, 2, 3, 4, 5, 6, 7, 8, 9 and 10. For the next 10 years, you will be generating how much cash inflows? So you will be getting 6,000 rupees every year, correct? You will be getting 6,000 rupees every year. 6,000 and 6,000, right? Now, payback period means what? Payback period refers to how much time it takes to recover my initial cash outflow. I have invested 30,000 rupees in the business, correct? How long will it take for me to get back my initial investment? See, what we will do is cumulative cash flows. So in the first year, you have got how much? 6,000 rupees. In the second year, how much you have got? 6,000. So at the end of year 2, till date, how much you have got? 6,000 plus 6,000. Can I say 12,000? Yes. At the end of year 3, how much you have got in total? 6,000 plus 6,000 plus 6,000, that is 18,000, correct? At the end of year 4, you have got 18,000 plus another 6,000, 24,000, right? At the end of year 5, you have got how much? 24,000 plus 6,000, 30,000. Yes. So technically speaking, can I say it takes 5 years for me to get back my initial cash outflow. Are you clear with this? And this 5 years is what is called as my payback period. Payback period means what? The time that a project takes to recover my entire cash outflow. Are you clear with this? Now, you tell me, if the payback period is less, it is beneficial for me. Why? Quickly I can recover my entire cash outflow. Yes or no? So, lesser the payback period, better it is for the company. Are you clear with this? So, looking at from a payback period perspective, lesser the payback period, better it is for the company. Why? Because you can get your entire amount, you can recover your entire outflow at a quicker point in time itself. Are you clear with this? Are you clear with this? Or since in this question the cash flows are equal, the cash flows can also be unequal, right? Since in this question the cash flows are equal, for equal cash flows there is a very simple formula to calculate this. So you can say that cash outflow divided by cash annual cash inflow, that is nothing but 30,000 rupees. So your payback period is nothing but 30,000 rupees divided by 6,000 rupees. So how long does it take? I need to recover 30,000. Every year I'm recovering 6,000 rupees, which means it takes 5 years for me to recover my entire capital. Are you clear with this? So this is a formula that you can use provided the cash flows are equal. Suppose the cash flows are unequal, then you need to use this method, that is cumulative cash flow model, and you should see when exactly the cash flow you are able to actually match it, when exactly you are able to recover your entire principal. You need to see it. Are you clear with this? So that is the first part of the question. Payback period is what? 30,000 divided by 6,000, 5 years. So which means it takes 5 years for you to recover back your entire investment. Are you clear with this? What do you mean by discounted payback period? Very simple. In this case, what we did cash flows. We just saw the cash inflows, and directly we saw how long my cash inflows will take, how long my cash flows will take to recover back my entire principal. Yes, this ignored time value of money. Correct. Here we did not consider any time value of money. 6,000 at the end of year 1 is not same as 6,000 at the end of year 2, but we just considered 6,000 everywhere and we just went across. Correct. Now in this discounted cash flow model, what we need to say is we need to discount all the cash flows. That is, all these cash inflows should be discounted. You should arrive at the present value of cash flows, and you should see how long it takes for the present value of cash flows to recover back your original investment, initial outflow. Are you clear with this? I'm repeating. Discounted payback means the period it takes for your discounted present value of cash flows to recover back your initial outflow. We will see with this particular example. In this case, discount rate is given as 15%. Discount rate is nothing but your weighted average cost of capital. So 10 years, every year you have what? Every year you have a cash flow of 6,000 rupees till the end of the 10th year. Yes. What is the present value interest factor? 15 years. Yes, you know how to compute the PV factors and all. We've seen this in the basic concepts, that is time value of money concepts. In case you have not seen it, it's been uploaded in a separate demo lecture. So please watch it. In case you do not know the basic concepts of time value of money, please watch it, because it's a lengthy discussion by itself. Since it is not a separate chapter in our study material, I have kept it as a separate video from this marathon, because if you know time value of money concepts, you need not watch it. You can directly enter into this marathon. Else you need to refer the time value of money concepts and come into this. You can just brush it up. Clear? So now, yes, there is a way in which you can calculate 1 divided by 1.15. I've given you the calculator trick and all, is equal to, you get this once again, as 870 or 0.8695. So they have rounded off to 0.870. Once again, click is equal to, you will get the second figure. Once again, click is equal to, you will get the third figure, is equal to fourth figure, and so on. So the present value interest factors, you will get it. Correct? In exam, at times they might give this table itself, or if they have not given you the table, they have just given the rate, you can do it easily with your calculator. 1 divided by 1.15 is equal to first figure. Once again, click the is equal to second figure. Once again, is equal to third figure, and so on. Right? So what is the present value of cash flow? The relevant cash flow into the present value interest factor. So the present value of cash flows for the relevant year, so you have arrived at it. Are you clear with this? This is nothing but what? This is nothing but the cash flow, that year's cash flow multiplied by present value interest factor. So this 5220 is what? Today's value, the present value of 6,000 rupees arising at the end of year 1. 6,000 rupees at the end arising at the end of year 2 in today's value is how much? 4536. Correct? This is called as time value of money. Yes. So now what we will do? We will do cumulative present value. So at the end of year 1, how much you have earned? So till now, how much cash flow you have? 5220. Now at the end of year 2, how much you have? till now 5220 plus that year's cash flow of 4536. So till now you have earned how much? 9756. Now at the third year, how much you extra earn? 3948. So 9756 plus 3948, till now you've got 13,704 rupees, correct, of total cash inflows. Then 13,704 plus your 3432 gives you 17,136. So at the end of year 4, till now you have cumulative cash inflows of how much? 17,136. Then at the end of year 5, 2982 is the amount. So 17,136 plus 2982 gives you 20,188. Then plus 2572 gives you 22,710 plus 2256 gives you 24,966 plus 1962 gives you 26,928 plus 1704 gives you 28,632 plus 1482 gives you 30,144. So technically, how much you have invested? 30,000, but present value of cash flows, when you are able to recover at the end of 10th year only, I am able to recover this entire amount of 30,000, or technically speaking, the discounted payback period is how much? Approximately 10 years. Look, the cumulative total of discounted cash flows after 10 years is how much? 30,144. Therefore, our discounted payback period is approximately 10 years as opposed to 5 years under simple payback period. Under simple payback period, what we said, if you invest the money of 30,000 rupees, you will get it back in 5 years. But that was done ignoring time value of money. If you consider time value of money, the discounted payback period doubles in this case. In this case, it becomes how much? It becomes 10 years. Are you clear with this? So for me to get back my original amount of 30,000 by considering my discounted cash flows, it takes me 10 years approximately. Are you clear with this? Yes. So it should be noted that as the required rate of return increases, the distortion between the simple payback and the discounted payback grows. That is, if your rate, that is if your discount rate keeps on increasing, so accordingly what will happen? Accordingly, if your discount rate is increasing, so cash flow divided by 1 plus r to the power n, correct? So if your discount rate increases, the overall value decreases, correct? Since your overall value decreases, now it takes more time for you to recover your cash inflow, or in other words, the discounted cash flow the discounted payback period will be further more. Are you clear with this? So when there is an increase in the discount rate, your discounted payback period will be more. Are you clear with this? This is what they are saying here. But just understand that payback period means what? The time it takes to recover my entire cash outflow. What do you mean by discounted payback period? The time that my discounted cash flows takes to recover my entire cash outflow. Are you clear with this? That is, the first one does not consider time value of money, the second one considers time value of money, and both the methods you will go for that. So like this, you will compute for multiple projects or multiple machines. You will compute what the payback period and discounted payback period. So if you're going by a payback period or discounted payback period, you will go for that particular machine or that particular investment alternative that has a relatively lesser payback period or lesser discounted payback period. Why? Because lesser payback or lesser discounted payback period means what? You are able to recover your initial investment quickly itself. Are you clear with this? So payback periods, whether discounted or not discounted, always remember, lesser the better. Are you clear with this? As simple as that, guys. As simple as that, right? So so directly we have completed two other models in this particular area. So we have completed what? We have completed two other models, that is payback and discounted payback period. So payback is done. Discounted payback period is also done. Clear with this? Yes. Now let's go to the next few methods in your discounted cash flow methods. Let's go to the next few methods. We will see this NPV, profitability index, and IRR. What these are, we will be seeing right now. NPV, profitability index, IRR. So what are they? This is what we are going to be seeing right now. Yes, and modified in IRR is actually a rarely tested area, and it's an intricate discussion that requires a lot of reasoning and all that. So in my marathon, I'm not discussing this alone. MIRR alone, I'm not discussing. I'm not doing some relating to that. I think in the study material itself, there is only one or two some. But the main area which are important from an examination perspective, I'm going to focus on that. In fact, I'm going to do a couple of case studies relating to your NPV methods, a couple of case studies which generally students find it difficult and all. That is what we are going to focus more on from an examination perspective. Overall, this chapter also we are covering everything except MIRR. Clear with this? Yes. Now, let's go to this NPV, profitability index, IRR. So what are all these things? This is what we're going to do right now. NPV method. Obviously, this method considers what? Time value of money. What do you mean by NPV? The net present value technique is a discounted cash flow method that considers the time value of money in evaluating the capital investments. The net present value method uses a specified discount rate. What is a specified discount rate? KO, correct? So when you are doing NPV, you already have a discount rate with you, correct? To bring all the subsequent cash inflows after the initial investment to the present value, correct? The time of the initial investment here is 0. So what do you mean by net present value? The present value of cash inflows minus the present value of cash outflows. Outflow is nothing but your initial investment. Are you clear with this? So what do you mean by net present value? So present value means what? Bringing everything into today's value by discounting. Why is it called as net? You are netting out your inflows with your outflow. That is why it's called as a net present value. So net present value means what? The present value of cash flows after tax minus my initial investment. Initial investment is already in today's value. It is already in present value. So because initial investment is made in T0, that is year 0, correct or not? And this NPV concept, we have already seen it. We have already seen it from a numerical perspective in this basic concepts. Right now, from an investment perspective, we will be seeing. So how will you calculate the NPV? So NPV is equal to present value of cash inflows minus initial investment, correct? Minus initial cash outflow. The initial investment is I, correct? Minus I, fine. Whereas the present value of cash inflows, how will you get it? Cash flow at the end of year 1 divided by 1 plus k to the power 1 plus cash flow at the end of year 2 divided by 1 plus k to the power 2 plus cash flow at the end of year 3 divided by 1 plus k to the power 3 and so on till cash flow at the end of year n divided by 1 plus k to the power n, correct? The life of the project will be given. So every year's cash flow you need to discount it. Now in this case for NPV, what they will do is the discount rate will be given in the question, which is generally your overall cost of capital. Are you clear with this? Why am I stressing on this? Because in IRR we will be calculating a rate. And that rate is not a discount rate. That rate is called IRR rate. What it is, I will tell you when we are getting into IRR. But for the time being, you just understand in NPV method, the discount rate that we use is your weighted average cost of capital. Are you clear with this? Using this weighted average cost of capital, you bring all the cash flows in today's value, in present value, and net present value means present value of cash inflows minus present value of cash outflow. Your present value of cash outflow is nothing but your net initial investment. Are you clear with this? Now, if your NPV is positive, that is, if your cash inflows, the present value of cash inflow is greater than present value of cash outflow, which means NPV is positive, correct? If the NPV is positive, then it means that overall, this project, this investment avenue generates some positive return. So you can go for the project. Are you clear with this? If your present value of cash inflow is less than the present value of cash outflow, so what happens? Your NPV is in negative, which means you should never go into this project. Why? If you get into this project, there is a loss after considering the time value of money. Are you clear with this? Yes. Are you clear with this? Yes. Look at this. If the NPV is greater than or equal to 0, you can accept the proposal. If it is less than or equal to 0, you should reject the proposal. So technically speaking, this equal to should not come. Here also, in both the places, if the NPV is greater than 0, generally you can accept it. If it is less than 0, you should reject the proposal. Are you clear with this? Are you clear with this? This is about your NPV. Are you clear with this? Now, an extension of NPV is only called as profitability index. Now, what they are saying is, this is just for representation purpose. There, NPV is what? NPV is present value of cash inflows minus present value of cash outflow, correct? Now, profitability index, this is nothing but, this is a ratio. This is present value of cash inflow divided by present value of cash outflow. Or in other words, you can say if your profitability index is greater than 1, it means what? The numerator is more than the denominator. Yes. Or in other words, inflow is more than outflow. It means that the NPV is positive. Are you clear with this? If your profitability index is less than 1, meaning what? Inflow is less than outflow or in present value. So your NPV is in negative. Or in other words, can I say, if the profitability index is greater than 1, you can accept the proposal. If the profitability index is less than 1, you should not go for the proposal. Technically speaking, it's an extended arm of NPV method only. Are you clear with this? Yes, are you clear with this? So if it is greater than or equal to 1, accept it. If it is less than or equal to 1, reject it. Ideally here also, if it is greater than 1, accept. Less than 1, reject. That's how it generally should be. Are you clear with this? In case of mutually exclusive projects, the project with a higher profitability index should be selected. What does it mean? Let's say I have an option. I'm telling you A, B, C. Out of these 3 machines, you can only invest in one machine. Then what will you do? Let's say machine A has a profitability index of 1.2. Machine B has a profitability index of 1.4. Machine C has a profitability index of 0.9. Which machine will you choose? I will go for machine B. Now, that is called as mutually exclusive. Mutually exclusive means what? You can only choose one. Suppose it is not mutually exclusive. They are saying you can choose how many ever projects you want. You can go for A, B, C or A, B, whatever you want you can take. Then I will say I will go for A as well as for B. Why? Because in both these projects, the present value of cash inflow is greater than the present value of cash outflow. So both these projects are profitable. I will go for it. Suppose they are asking me to choose only one, that means mutually exclusive. So in case of mutually exclusive decision, what I will do? I will go for that project that has a highest NPV or highest profitability index. Are you clear with this? Are you clear with this? This is about your profitability index. Next. So profitability index is nothing but sum of discounted cash inflows divided by initial outlay or the total discounted cash outflow, as the case may be. Are you clear with this? That's about it. That's about it. Next. Internal rate of return. We have seen this in depth in our basic concepts. The video is already there in our YouTube channel. Please watch it in case you do not get a hold of this IRR. This is something that we saw in our basic concepts, because the concept of IRR was also there in our cost of capital chapter and all. So that is the reason why I already did this in basic concepts, which is also uploaded in our YouTube channel, right? So now, what is your IRR, internal rate of return? What is your internal rate of return? Guys, very, very important. Remember one thing, IRR is a percentage. Clear? IRR is a percentage. It is calculated in percentage. That is what we will do is, suppose in this question, let us say, okay, so let us say this is what they had given. Okay, so 100 crores is given. Let's say, let me just take this example as a model. One second. Okay. Now, let us say this is the data given in the question. What is the data given in this question? They are saying this is all is given in the question, guys. Please carefully listen. Students again get confused here. So that's why I want to give you a lot of clarity on this area. This is the data given in the question. Let's say the company can invest in machine number A. Okay. If the company wants to invest in machine A, initial outflow is how much? 100 crore rupees. They need to, let's say machine A or project A, correct? It's an investment alternative, fixed asset, non-current assets, whichever way you want, you can say. Now, if I want to invest into this project, initially I will have to spend how much? 100 crores in buying the machines and all that. And at the end of year 1, it generates a cash flow after tax of 30 crores, year 2, 25 crores, year 3, 15 crores, year 4, 10 crores, and year 5, 12 crores. Clear with this? Fine. Just one second. Okay. So I'm just changing this cash flows. You don't worry why I've changed the figures. I'm just giving you an example, right? So let's say if I want to invest in this machinery, beginning in today I need to invest 100 crores. If I pay 100 crores and buy this machine, using this machine, I will be able to generate the following cash inflows. That is 40 crores at the end of year 1, 38 at the end of year 2, 35 at the end of year 3, 20 at the end of year 4, and 15 at the end of year 5. Let's say these are the cash inflows that I will be able to generate. Now, you tell me, what is the return that I am able to get out of this particular project? That is, what is the return? Net return, how much am I earning from this particular machine? If I invest 100 crores today and get this following cash flows, technically, what is the return that I am getting out of this project? This return calculation is only called as IRR. Are you clear with this? Or in other words, outflow is given, inflow is also given. Calculating R is called as, calculating the discount rate is called as what? It is called as your IRR. Now let me just give you a small example. Let's say you have invested 100 rupees today, right? Yes, you have put it in an FD. At the end of year 1, you get how much? Let us say 110 rupees. They pay along with the interest. Now tell me, what is your so what is going to be your return in this case? Now what is going to be your return in this case? Now can I say it's very simple. What is the big deal, sir? 100 into 1 plus r the whole power 1 is equal to 110. They have paid some interest, we know that, correct? They have paid some interest, or in other words, 100 into 1 plus r the whole power 1 is equal to 110, correct? Or can I say 1 plus r the whole power 1 is equal to 110 divided by 100, correct? Or in other words, 1 plus r the whole power 1 is only 1 is equal to, can I say 1.10? Or can we say guys, can we say r is equal to 1.10 minus 1? So r is equal to 0.10 or 10 percentage, correct or not? Yes. Now a simple, so forget this IRR for the time being. Simply I'm just saying you invested 100 rupees on an FD. At the end of year 1, you got 110 rupees. What is the return? This is simple. One cash outflow, one cash inflow. Directly you can use the simple interest, the compound interest formula you can use and directly find the R value, correct or not? So we just say 100 to 1 plus R the whole power 1 is equal to is equal to what? Is equal to your is equal to 110, correct? Or in other words, can I say 1 plus r the whole power 1 is equal to 110 by 100? Or in other words, if you do this, you get the net return as 10 percentage, correct or not? Yes. Or in other words, what we are doing here, in other words, what we did here, so basically for us to find this out, what we did, what we are doing, we just did 100 into 1 plus r the whole power 1 is equal to 110. We equated the cash inflow with the cash outflow, correct? Or can we say 100 is equal to 110 divided by 1 plus r the whole power 1? This is what we did. Or in other words, can I also say the rate that equates my present value of cash inflow with my present value of cash outflow is called as IRR. Are you clear with this? So basically, inflow outflow is all given. The balancing figure is R. That alone we need to find. Or in other words, can we say the net rate of return that I get is nothing but the rate that exactly equates my present value of cash inflow with my present value of cash outflow. Or you can say present value of cash outflow with my present value of cash outflow. Present value of cash outflow with my present value of cash inflow is called as IRR, correct or not? Yes. Now, in this case, it was a very simple calculation. Why? Only one cash inflow, one cash outflow. That's about it. Whereas here, there is one cash outflow followed by a series of cash inflow. Yes or no? Now, in this case, there is no formula method and all. There is no method to calculate. There is actually no formula to calculate IRR till date. Are you clear with this? So then how will we calculate, sir? By using trial and error method. So what we will have to do is, so what do you mean by IRR? IRR is the rate that equates my present value of cash inflow with my present value of cash outflow, correct? So present value of cash inflow should be equal to my present value of cash outflow when the rate is IRR rate. Are you clear with this? Now in this example, you tell me, what is my present value of cash outflow? 100 crore rupees, correct? Guys, actually I've done all these things, the basic concepts, still I'm just touching it upon once again. This should be equal to the present value of cash outflows. So since this is an investment decisions, there is an initial outflow followed by a series of cash inflow. Are you clear with this? Yes. So initially, how much I spent? 100 crores was the inflow. Sorry, 100 crores was the outflow. I had to shell out 100 crore rupees in purchasing this equipment, followed by a series of cash inflow. I get 40, 38, 35, 20, 15 respectively. Yes. Can I add it as such? No. I need to convert, I need to discount everything into present value. So how will I do it? Can I say this is equal to 40 divided by 1 plus r to the power 1 plus what is the second year's cash flow? 38. 38 divided by 1 plus r to the power 2 plus what is the third year cash flow? 35. 35 divided by 1 plus r to the power 3 plus, can I say this is 20? 20 divided by 1 plus r to the power 4 plus finally you have 15 crores. 15 divided by 1 plus r to the power 5. Yes or no? Or in other words, can I say the rate that equates my present value of cash outflow with my present value of cash inflow is called as IRR. Yes or no? Now, one more additional thing I'm saying. Now, can I say, if I take this present value of cash outflow to this other side, so can I say 0 is equal to present value of cash inflow minus present value of cash outflow, correct or not? So if your rate at your IRR, your present value of cash outflow will be equal to your present value of cash inflow, yes, that is the rate that equates my inflow with my outflow is only called as IRR, correct? Or in other words, can I say at IRR, my present value of cash inflow minus present value of cash outflow will be equal to 0, correct? Now, present value of cash inflow minus present value of cash outflow is popularly called as NPV. Yes, guys. Or in other words, can I say IRR is the discount rate that makes my NPV equal to 0. So, can we say 0 is equal to 40 divided by 1 plus r to the power 1 plus 38 divided by 1 plus r to the power 2 plus 35 divided by 1 plus r to the power 3 plus 20 divided by 1 plus r to the power 4 plus 15 divided by 1 plus r to the power 5. This is the present value of cash inflows minus 100 crores, minus 100. Are you clear with this? So the present value of cash inflow minus present value of cash outflow gives you your NPV, or in other words, NPV is the rate that makes my IRR, I'm coming again. So your IRR is the rate that makes your NPV equal to 0. Are you clear with this? Are you clear with this? So now, sir, how will we calculate? How can we find this IRR? So you said there is no formula. You need to do some trial and error method only. How will you do it? What the first assumption? Just an example. Let R is equal to 10%. You substitute it in the equation and see if you are getting exactly equal to 0. Let us say you are getting some positive figure, it is not 0. Then what you need to do? So now you need to take a second trial. So you will take the second trial as, let's say, 12% or 15%, as the case may be. You can take any figure. So you will get one negative IRR. Correct? You will get a negative NPV, right? So you clearly know that. So for a positive NPV, if you take your discount rate as 10%, you are getting a positive NPV. If you get a 12% discount rate, it is negative NPV. So basically, your IRR lies somewhere in between what? 10% and 12%. You do that interpolation. What is that interpolation? That formula is only given here. Lower rate, that is lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. Or in other words, what we do is we take this as the base, 10%, just an example, 10%, this is the lower rate, plus NPV at the lower rate. So for 10%, whatever is the NPV, this positive figure you will write down, correct? Now divided by what is the NPV that you require? So you have a positive NPV here. You want to make this as 0. Are you clear with this? So what we do here is NPV at lower rate minus NPV at a higher rate. That is the difference between these two we take. correct, the difference between these two figures, these two NPVs we take, correct, into high rate minus low rate. This is what we get. This is what we get for the difference between these two rates, 12 minus 10, 2. Then how much should we get? How much should we get to make this difference of lower rate? This is what is called as interpolation. So for this figure, how much should be the extra discount rate that we need to get? So that is the formula. Logically, we have seen all these things in our IRR detailed explanation with numerical problems we have seen. So lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. None of this needs to be mugged up. Are you clear with this? Now, let's say, for example, now this 10%, 12% and all. Sir, how will I know to take 10% or how will I know to take 12%? It need not be between this. If you first take 1%, say you take 15%, see whether you get a positive NPV or negative NPV. Sir, I'm getting a positive NPV, which means what? Which means what? If you're getting a positive NPV, which means if you now need to reduce, if you're getting a positive NPV, what you now need to do, you need to bring down the overall NPV to 0. So you increase your denominator. If you increase your discount rate, so it will be your overall NPV will reduce. So the next trial you take above whatever you have taken in the first trial. Are you clear with this? But make sure that one trial gives you a positive NPV, one trial gives you a negative NPV, and using the interpolation technique, you can find your exact IRR. Sir, in real life, is it so difficult to calculate IRR? No. In a click of a button, you can just calculate IRR using various various softwares. The basic software that you can use is even spreadsheet, your Excel spreadsheet. So equal to XIRR, and if you just put the figures, it will automatically come. There are so many softwares. We just key in, basically, if you just enter all the cash flows, the end of relevant years, automatically calculate IRR. If you just one click of a button, it will calculate. But for examination purpose, since they want to test you on the concept, they are asking you for trial and error method. But understand, in real life, IRR calculation is very simple because there are a lot of softwares that can compute this in a fraction of a second. Are you clear with this? And this entire IRR, how to calculate this and all, we have seen it in our basic concepts, in our basic concepts chapter. In case you have not seen it, in case this particular area you are finding it difficult, I would suggest that you please watch the IRR video in the basic concepts, so that it's a separate video that's been uploaded. So please ensure that you watch it in case you have an issue with this particular IRR understanding, because I've made a separate video on this. It's a very elaborate discussion. So I would suggest that in case you are finding it difficult to follow this IRR area, you go to that video, watch it and come back. Are you clear with this? Yes. So with this is what is called as IRR, and we have computed the internal rate of return. Basically, what do you mean by IRR? IRR is nothing but you are calculating the return on investment. So return on investment is easy only, no sir? Yes. It is very easy to calculate return upon investment, correct? But provided there is only one cash flow, you have multiple cash flows, then you need to do it only like this. So technically, IRR in this chapter represents what? What is the net amount of return that I get for the investment that I have made? Are you clear with this? Now this is called as IRR. Yes. Now be very, very clear. IRR is the rate that makes my NPV 0, correct? Whereas NPV calculation is generally done by taking your discount, R as discount rate. Discount rate is what? Their weighted average cost of capital. Yes or no? So always remember, NPV is calculated by taking R as what? Discount rate. That is your weighted average cost of capital. Whereas this particular question, this particular area, IRR, the question itself is about calculating the discount rate. The discount rate, IRR, is nothing but the rate that makes my NPV equal to 0. That is called as my IRR. Are you clear with this? So there are two discount rates in this chapter. One is called as weighted average cost of capital, which is the relevant discount rate used for computing your NPV. Whereas IRR calculation itself is a calculation of the rate that makes my NPV equal to 0. Are you clear with this, guys? Are you clear with this? So basically, IRR is the rate that makes my present value of cash inflows equal to my present value of cash outflows. Now you tell me, IRR is nothing but the net return that is generated out of my investment, correct? Now, sir, why is IRR useful? Guys, very, very simple. Now look at this. I know that if I raise funds, there is something called as cost of capital, KO, correct? And if I invest these funds here in various investments, I know the net return that it generates, IRR, Very simple. If your IRR is greater than your weighted average cost of capital, you can go for the project. If your IRR is less than your weighted average cost of capital, then you should not go for the project. Very simple, guys. Yes, are you clear with this? That is what they have mentioned here. If your IRR is greater than or equal to the cutoff rate, popularly known as WACC, accept the proposal. If it is lesser than the cutoff rate, then reject the proposal. Are you clear with this? Are you clear with this? This is all the story about your IRR. How to compute IRR, we have already seen in basic concepts. I just gave you a bird's eye view here. If you are not clear with it, please watch the basic concepts video separately. That is separately there in our channel. But this one, are you able to understand how this IRR is related to our investment decisions? Are you clear with this? So with IRR, what will I do, sir? Compare it with the weighted average cost of capital. IRR is your return. Weighted average cost of capital is your cost. It is a cost used for raising my finance. IRR is nothing but the return that I generate by investing the finance. So if my return is more than cost, I will go for it. Or in other words, IRR greater than WACC, go for the proposal. IRR less than WACC, don't go for proposal. Are you clear with this? As simple as that, guys. It's very, very simple. Clear? So what is NPV? NPV is nothing but present value of cash inflows minus present value of cash outflows. How will you arrive at the present value? By using the discount rate as your weighted average cost of capital. Here IRR has no role to play. Are you clear with this? The discount rate is your weighted average cost of capital. Then what is your profitability index? Your present value of inflow divided by present value of outflow. So basically, if it is greater than 1, you will accept. If it is less than 1, you will not accept the proposal. And IRR is the rate that equates your present value of cash inflow with your present value of cash outflow. Or in other words, IRR is a rate that makes my NPV equal to 0. So what is the decision criteria here? If your IRR is greater than WACC, go for the proposal. IRR less than WACC, don't go for the proposal. Are you clear with this? These are the 3 things that I wanted to tell you. Now there is a very interesting question given in the study material. So I want to explain this question. So let's quickly get into this particular question. This question is about missing figures. Missing figures using the concept of IRR, NPV, cost of capital, profitability index or not. So now this is nothing more than testing how well you know this particular concept. Are you clear with this? So let's get started into this area right away. The following data is available for a capital project. Annual cash inflows. Every year it generates cash inflows of how much? 1 lakh rupees. Useful life 4 years. Salvage value at the end of the project 0. IRR is given as 12%. Guys, be very clear. I told you IRR is different. Your cost of capital, discount rate is different. Clear? IRR is 12%. PI means what? Profitability index is 1.064. You are required to calculate the following: cost of the project, cost of capital, net present value, and payback period. They are not asking you for discounted payback, just a payback period. Are you clear with this? These are the missing figures. Now, what I would suggest is pause this video right now. Take a rough notebook. Try to crack this by yourself. Don't look at the solution. Try to crack this by yourself. It's an institute study material question. Now, if I am an examiner, I would be interested in testing you this question for a simple reason. I'll tell you the open reason why I would be, if I put myself in the shoes of an examiner, I would be interested to pick this question because single question tests you on concepts of IRR, NPV, cost of capital, profitability index. Sir, here many things are given already. You will at least know how to use it. You should know how to use it. Don't think all questions are computation driven. Certain questions are also logic driven. In fact, most questions are logic driven. You should know what to use, how to use this data and arrive at the missing figures. Very, very important. Are you clear with this? So now let's get started. So in case you still not aware of this particular question, please pause it right now and try to crack this question by yourself and then check the answers. Now, what have they given? PV factors also they have given. Look, 12%, 11%, 10%, 9%. They have given the PV factors also. Right. So now let's see how to do this particular question. Now, what have they given? What have they given? Guys, where do we start with it? They have given that annual cash flows are how much? 12%. They have also given IRR is 12%. Life is 4 years. Can I say? Now. IRR is the rate that equates my present value of cash outflow with my present value of cash inflow. Yes or no? Yes. Now, what is my present value of cash inflow? Every year, I am having 1 lakh. 1 lakh equal amount. So, can I say 1 lakh into present value interest factor annuity of 4 years at the rate 12 percentage? Yes or no? So can I say the initial cash outflow is equal to my present value of cash inflow? Yes. Present value of cash inflow is nothing but annual cash flow. Since it is equal, I can use the annuity table into present value interest factor of annuity of 4 percentage for 12 years. Yes, guys. Now they have given 12 years, they have given the discount present value table. So if I add these four, I will get the present value interest factor of annuity. Yes or no? So can I say annual cash inflows is 1 lakh? Yes. So considering the discount factor of 12 percentage, the present value interest factor of annuity of 4 years for 12 percentage is going to be how much? 0.893 plus 0.797 plus 0.712 plus 0.636. It gives you a total of how much? 3.038. Guys, these are all time value of money concepts, correct? So 3.038, correct? So basically it's nothing but 1 lakh into 3.308. So the sum total of the cash inflows is going to be how much? 3 lakh 3,800, correct? And at IRR, your cash inflow is equal to your cash outflow. So basically your cash outflow, or in other words, the project cost is how much? 3 lakh 3,800. Are you clear with this? This is how you need to do this particular question. So first they had asked for what? Cash. They have asked for the cost of the project. They have given the annual cash flows. They have given the IRR rate. What do you need to do? The present value of cash inflows using the IRR rate will be equal to my present value of cash outflow. Present value of cash outflow is nothing but the cost of the project. Are you clear with this? Cost of the project. That is the only cash outflow I have. Yes or no? So you just need to take 1 lakh into present value interest factor of annuity of 4 percentage for 12 years and you will get this answer. Guys, that's simple it is, provided you know how to apply it. Next, calculate what? Calculate the cost of capital. You should calculate what? Cost of capital. Now, how can we calculate cost of capital? We should use profitability index. Now, profitability index is equal to what? Present value of cash inflows divided by present value of cash outflows. Now, remember guys, for profitability index and NPV, the present value of all the cash flows should be done at what? It should be done at the discount rate here should be what? Your cost of capital, and we need to calculate that only right now. So don't consider 12 percentage for this, because 12 percentage is your IRR that makes your NPV equal to 0. Are you clear with this? Here we are only going to we are going to compute the discount rate only right now. The discount rate is the weighted average cost of capital that is used for your NPV and profitability index calculation. Now what is your profitability index? 1.064 is equal to present value of cash inflow divided by what is the present value of cash outflow? That is the project. What is the project cost? We just got the project cost as 3,03,800. Yes, guys, divided by 3,03,800. Yes or no? Or in other words, can I say, present value of cash inflow is equal to, just cross multiply 3,03,800 multiplied by 1.064. So how much do you get? 3,03,800 into 1.064. So how much do you get, guys? So 1 second. So 3,03,800 into 1.064. You get how much? You get 32 lakh. 1 second. I'm sorry. 3,03,800 into 1.064. That gives you, yes, 3,23,243.2 approximately, correct? So this gives you 3,23,243.2 approximately. Yes, guys. Or can I say the present value of cash inflows is equal to 3,23,243. Yes, guys. Present value of cash inflows, how will you get? It is nothing but 1 lakh rupees. Every year there is 1 lakh rupees into present value interest factor annuity of X percentage. I don't know how much the percentage. That's what I need to calculate. For how many years? For 4 years is equal to 3,23,243. Yes. Or can I say present value interest factor of annuity for X percentage 4 years is going to be how much? 3 lakhs divided by 1 lakh. So can I say this is 3.23243. Yes, guys. So now what you need to do in this table, you should go and see if you add up at what rate it becomes 3.23423. Yes. At what rate? 3.23. So at 3.232, at what rate it becomes? When your R is 9%. So you calculate R 9%, you sum total of this. Since it's an annuity table, you are sum totaling this 0.917 plus 0.842 plus 0.772 plus 0.708. How much is that? 3.239. Are you clear with this? So 3.239 approximately, you are getting it here. So can we say that here the relevant discount rate, x at the rate of 4%, x percentage is how much? 9%. So now can I say the cost of capital is how much? 9%. Are you clear with this? Are you clear with this? So what we did, we started with profitability index. What is profitability index? Present value of cash inflows divided by present value of cash outflows. You have the profitability index, you have the present value of cash outflow. So the balancing figure is how much? Present is what? That is your present value of cash inflow, correct? So my present value of cash inflow is this. So present value of cash inflow is nothing but my annual cash flow into present value interest factor annuity of x percentage into 4 years. This x percentage is only my cost of capital percentage. Why? Because profitability index and NPV and all is calculated only using my weighted average cost of capital. This is different from my IRR, correct? So this is going to be how much? This is going to be 9%. Guys, are you clear with this? Is everyone clear with this? So technically, if you see in this question, what is cost of capital? 9%. Yes. Now, just a small understanding. So your cost of capital, weighted average cost of capital is how much? 9%. Correct? That is, you have borrowed, you have raised funds by paying 9% and you are investing it in projects that is generating how much? 12%. So that's why you can go for the proposal or not. Yes, that is the reason why this profitability index is also showing 1 point something. It is greater than 1. Why greater than 1? Because the present value of cash inflow is greater than my present value of cash outflow. That is the reason why you are actually showing what? You are showing actually a profitability index of more than 1. Why is it more than 1? Because my IRR is greater than my cost of capital. Guys, are you able to connect the dots here? Are you able to connect the dots? It's as simple as that. Simple finance, if you just know it logically, you will be able to apply it. Then net present value, very simple. Present value of cash inflow minus present value of cash outflow. We just calculated the present value of cash inflow using the weighted average cost of capital. So 3,23,243, correct? So 3,23,243. Look at this, 3,23,243.2 minus 3,03,800. Present value of cash outflows, the cost of project. So it's going to be how much? Positive. NPV showing positive 19,443. Why NPV showing positive? Obviously because my IRR is greater than my weighted average cost of capital, correct? Since my IRR is greater than my weighted average cost of capital, what happens? My NPV is actually greater than 0. Yes, guys, or in other words, my profitability index is greater than 1. Why? In the numerator you have inflows, present value inflows. In the denominator you have present value outflows. If your present value of inflows is greater than the outflows, only then it will be greater than 1. Guys, are you able to connect all these three things together? Your IRR, NPV, profitability index, these are all some interrelated things. Students think these are some different things that we need to know. No. This is like a chain which you need to understand together. Are you clear with this? Because my IRR is greater than my weighted average cost of capital, it makes my NPV greater than 0, which makes my profitability index greater than 1. Are you clear with this? So suppose my IRR is equal to my weighted average cost of capital. Suppose my IRR is equal to my weighted average cost of capital. So basically what happens in this case? So it is an indifference thing. So whatever is the return that you make out of your investment, exactly that you need to pay to your sources of finance. So basically it doesn't generate you any revenue at all. Or in other words, this makes your NPV exactly equal to 0. This makes your NPV exactly equal to 0. Yes, guys, are you clear with this? That is your IRR and WACC. If you are equating it, that is, if these two are coincidentally equal, this is what will happen. But that is not the subject matter of study here. Understand always, if IRR is greater than WACC, it generally means that your NPV is greater than 0, which makes your profitability index greater than 1. Understand the link between all these formulas. Are you clear with this? Yes. And finally, they had asked for payback period. So payback period is very simple. Payback period or discounted payback? Only payback period. So which means what? So I need to, how much time it will take for me to recover my entire investment? Very simple. What is the total investment? It's going to be what is the total investment? It's going to be 3,03,800 divided by 1 lakh, equal cash flows only. So you need not put the cumulative table and all. So it takes 3.038 years to recover your entire cash flow. Sir, can years be in decimals? Yes. So basically there's nothing but 0.038 years into 365. We do, it's actually 13.87 days. Approximately, this is nothing but 3 years and 13 days. That is the meaning of this. Are you clear with this? That's why they have put it as decimals. Yes, you can keep it in decimals. Don't round it off. Are you clear with this, guys? So approximately it takes 3 years and 13 days to recover my entire investment. This is the meaning of payback period. Guys, are you able to get the clarity? It is as simple as that. Are you clear with this? So we have seen all the methods right now. Now let's go to 2 problems which are exclusively case study types. Now these are some interesting questions which I feel are typically the exam type of problems that you can be tested. So let's go to question number 5 right now. Let's go to question number 5. Capital budgeting with working capital. Now this is a question which many students find difficult because they are not able to understand the question itself. Now guys, understand one thing. There is nothing new that we are going to study in this particular question. Understand that this is nothing more than applying the facts given in the question with whatever data we have studied till now. Are you clear with this? There is no rocket science that we are going to generate here. Whatever we have studied, we are just going to apply that with the relevant facts given in the question. Of course, one thing extra that we are going to see is something related to working capital, which ideally you will also get clarity once we do that working capital chapter revision. But anyways, it can be done right now, so that shouldn't be a problem at all. So if you see this question first, don't fear, because in my past interaction with students, they generally feel that if this big sum comes in, it is very difficult. It is very difficult to crack. Guys, I'm telling you, these are all some easy questions, provided the first thing is you should not have the fear when you read this question. Oh my God, this is a big question. So how am I going to crack it? No, throw the fear off. First, you read it. You logically think. You need not be a finance expert to crack this question. Logically, you think. I will explain word by word logically. You will see how easy these questions are. Clear? Fine. So let us do this question. Have the patience. Read it along with me. Follow my instructions. Trust me, automatically you will be able to crack these kind of questions. These kind of questions are typically can be tested for 10 marks, guys. And this chapter time and again gets tested for 10 marks. Every attempt, it gets tested for 10 marks. Almost every attempt. Remember, this is 10 out of 60 marks currently in the old syllabus. In the new syllabus, it's going to be 50 marks total. Out of the 10 marks, generally this chapter never gets missed out. Reason, it's a very important chapter. This chapter is also there in your CA final. In AFM, Advanced Financial Management, this chapter is as such there in your final, but of course with certain incremental learnings we will be having, but for that the base is going to be the same. So remember, this is a very important chapter for your entire CA career. Are you clear with this? At least till the time you finish your CA, you need this chapter for sure. Are you clear with this? Yes. Now let me just read this question out for you. Please do not have any kind of aversion against this chapter or this type of questions. Have an open mind. I'm saying this again and again because I have seen students who just cribble about this particular question, these kind of questions, like big questions. They are giving some case scenarios, they are giving, and they are doing some complex calculation. What is this? We don't even understand. Patiently, you just listen. I'll tell you, every single thing is logical. Now, a large profit-making company is considering a machine to process the waste produced by one of its existing manufactured process to be converted into a marketable product. Wait, what they are saying? A company is that a large profit-making company. Yes, what they want to do is considering to install a machine to process the waste produced by one of its existing manufacturing process to be converted into a marketable product. Now, let me just give you an example. Now, guys, if you have seen in this cosmetic products like Fair and Lovely or your Fiamma de Ville and all these L'Oreal, the face wash and all that, what they generally show is there will be a model and they will show some real fruits and all. They will show papaya extract and all. They will show the real fruits and they will say that this cream or whatever thing that they are selling is made of the real fruits and all. They will say like that. Yes, but technically speaking, you know what happens. So if they are showing orange pulp, they will definitely use, but more than the orange pulp, they will use what? They will use the orange peels and all. That is the outer shell of that orange. Now, don't think that it is bad. It is good only. Don't worry. But what I am saying is, in these advertisements, they show more of that orange pulp and they say we have made it using orange or we have made it using papaya and all. But actually, what they do, I'll tell you. Yes, they also use some extracts. I'm not denying it. You know, these companies like Tropicana, these companies that manufactures juice, what they do is they actually enter the juice. I mean, they enter the vegetables or they enter the fruits in the typically fruits, correct? There are also a few vegetables on the basis of which juices are made, but let's not talk about that. Generally, they actually input the juice, they input the fruits into the process, correct? And the processing happens, and then fresh juice comes as an output, and then this particular peels and all the leftover waste comes out as an output, correct or not? This also comes out on the other side, yes or no? So typically these kind of companies, just imagine they manufacture mango juice, papaya juice, whatever it is. Input is fruits, yet their output, their main output is juice, correct? But coincidentally, something else also comes out, that is nothing but all these waste as from their viewpoint, it is a waste. Clear? Don't think it's waste means it is not a usable product. So some papaya peels or some pulp, leftover pulp and all will be there. Now all these pulp and all these things is there, no? Correct? What these guys do, they do some further processing. Slightly they just process it and they sell this who? Tropicana. All their leftover waste. From their viewpoint, it's a waste. Again and again, I'm telling you, waste, don't take it as such. From their viewpoint, it's a waste. And that waste, they sell it to all these companies like Pond's, Piyama Devils and all these companies. Are you clear with this? Cosmetic industry. Are you clear with this? So advertisement, they show real papaya. What goes inside, I just told you. Right now, you decide. Now, coming back, I just took example of a few companies, guys. Nothing against these companies. Again, please don't make a big issue about it. I'm just telling you an example with reasoning. Now, what happens? Currently, what Tropicana is doing is, whatever is the waste that they are getting, all the fruit peel and all, they are throwing it away. Right? Now, for throwing it away, what happens? They are incurring some cost and all. Now, this company Tropicana is thinking that look, there is a ready market for us. If we slightly process this waste, we can sell it to this cosmetics guys. Are you clear with this? That is the thought process of this company. Now you read it. A large profit-making company is considering installation of a machine, new machine. What? To process the waste produced by one of its existing manufacturing process. Existing manufacturing processes, the juice manufacturing process. It generates what waste? That waste is only your fruit peels and the leftovers. Clear? This can be converted into a marketable product. At present, the waste is removed by a contractor for disposal on payment by the company of 150 lakh rupees per annum for the next 4 years. So what they are doing, currently, the company is throwing away all the peels. By hiring a contractor, you don't think it will be this much amount of peel. See, in your house, if you cut fruits and vegetables itself, you have this much amount of wastage left over, right? Now, just imagine a company which is into this business of manufacturing juices. They have a lot of waste. If from their viewpoint, they can't use it further, it has to be disposed of. So they are saying every year they incur 150 lakhs to just dispose of. No revenue from this. They are just disposing it off. Are you clear with this? Currently, the company is treating this as a waste and they are disposing it off by spending 150 lakh per annum. They have entered into a contract with an outside contractor for the next 4 years. Now, suppose this waste, if it can be processed and converted into a marketable product, now it need not be disposed of, correct? I can cancel this contractor and this contractor can be terminated upon upon installation of the aforesaid machine on payment of a compensation of 90 lakh rupees before processing operation starts. So what they are saying, now currently we have already entered into a 4-year contract with a operator, with a particular contractor. What is a contract? He has to come and remove all the, dispose of all the waste, and he should take up all the waste and throw it away. Correct? For him, I will pay 150 lakhs per annum. It's a contract already done. Suppose I don't want to dispose it, but I want to convert it into a marketable product. then I should cancel my contract with this particular contractor. He's saying if you want to cancel it, you need to pay a penalty of 90 lakh rupees. If cancelled, pay a penalty of 90 lakh rupees so that for the next 4 years, I will not trouble you. So all this 150 lakhs per annum and all, you need not pay. Are you clear with this? So if I wish to go for this, converting this waste into a marketable product, what I need to do, I need to incur additionally 90 lakh rupees. I need to pay to this contractor and say, wait, I had entered into your contract by mistake. Now I have changed my mind. I want to convert it into a marketable product. So I don't need your disposal services. So what I will do is I will pay this 90 lakhs as a penalty upfront. Are you clear with this? And this compensation is not allowed as a deduction for tax purposes. Clear. Next, the machine required for carrying out the processing will cost 600 lakhs. Now, if I want to process this waste into a marketable product, I need to buy a new machine exclusively for this. Correct? That will cost one-time investment 600 lakh rupees. At the end of the 4th year, the machine can be sold for 60 lakh rupees salvage value. And the cost of dismantling and removing will be 45 lakh rupees. That is, at that time, if I want to dispose of this machine, I will have to incur 45 lakh rupees. Are you clear with this? These are the details relating to the machine that I'm going to buy newly if I want to take up this further processing of wastage. Clear? So what are the costs? Initial 600 lakhs, correct? At the end of the 4th year, salvage value is 60 lakhs, but wait, the cost of dismantling will be 45 lakhs. So basically net off, you will get how much? 15 lakhs of cash inflow you can generate at the end of year 4 at the time of selling it off, scrapping it off. Clear? Now, the sales and direct costs of the product emerging from the waste processing for 4 years are estimated as under. So what they are saying, so now this project can have a useful life of 4 years, correct? It's a project. Fine. Now, if I use all these machines and with this machine, if I'm looking at this business proposal, year-wise, how much is the sale is given. Year-wise, how much material consumption is required, how much wages is required, how much other expenses is required, how much factory overhead is required, and how much is the depreciation computed as per income tax rule. Year-wise, these data are given below. Are you clear with this? So why have they given all these things? Yes, with this only we can compute the cash flows and all, correct? So sales, I need to take minus the material consumption, wages and all these costs, other expenses and all. Look at this, factory overheads is given and then depreciation is also given. Year-wise data is given. Clear with this, guys? Yes. Now, one more para they have given. Initial stock of materials required before commencement of the processing operation is 60 lakhs at the start of year 1. The stock levels of materials to be maintained at the end of year 1, 2 and 3 would be 165 lakhs. And the stock at the end of year 4 will be nil. Now, first, this particular line item, let us see. This is the important line item because many students get it wrong only here. Now, this is where I said this chapter is relating to your working capital management. Correct? We will be seeing details about the working capital management chapter in the next revision. Don't worry about it. It is an upcoming thing. We will be doing it in the next lesson. But right now, understand what is this. First of all, you should understand these are not costs. These are cash flows. Remember this, they are not cost, they are cash flow. So what you are saying now, every year, what is the material consumed is given 90, 120, 255, 255, it's given. That is year wise, raw material cost is already given by them. Correct, guys? That is not a problem here. Look what they are saying. Initial stock of materials required before commencement is 60 at the start of year 1, and the stock levels to be maintained at the end of year 1, 2 and 3 will be what? Will be 165 lakhs. Now what they are saying, guys, patiently listen. Year 1, 2, 3, 4. Opening stock, closing stock. Raw material consumed, that is only my cost required to calculate my cash flows, every year cash flow. Look at this here, they are talking about the stocks. What they are saying, initial stock of material, that is at the beginning, T0 itself. This is T1, year 1's opening stock. Generally, this is nothing but T0, correct or not? Today itself, I need to have a stock of how much? 60 lakh rupees. Guys, please understand this. I need to bring in stock worth 60 lakh rupees, correct? But during the year, I will be purchasing and I will be utilizing 90 lakhs. Don't worry, but I should definitely have my stock policy stays. I need to have an opening stock of 60 at the beginning. And look at this, the stock levels to be maintained at the end of year 1 to 3 will be 165. Now, my closing stock should be 165. Correct? Guys, correct? Yes. Now my closing stock should be 165. Yes or no? Yes or no? Now, I have already brought in stocks worth 60 rupees. Correct? Now, extra how much I should bring to maintain 165 rupees of closing stock? I should bring in 105 lakhs at the end of year 1. Why? Because they have given that the company's stock policy is such that they need to maintain a stock of this is what, 165, right? So 105. So they should maintain an overall stock of 165 at the end of year 1. Or can we put it like this? So what they have mentioned here, guys, a very interesting adjustment. In my opinion, this is a very, very good adjustment, and this is a likely exam question. So please focus on this. This is the certain type of question that can be tested for your exam. So look at this: year 0, year 1, year 2, year 3, year 4. Correct? What are they saying about the stock policy? What are they saying about the stock policy? Now, at present, you should bring in 60 lakh rupees worth of stock. Correct? Now, at the end of year 1, year 2 and year 3, the closing stock should be 165, 165, 165 respectively. This is what they had mentioned. At the end of year 1, 2, 3, the stocks will be 165 and stocks at the end of year 4 will be nil. At the end of year 4, it will be 0. Now, what they are saying, so year 0, that is at the beginning itself, you bring in 60 lakhs, correct? So at the end of year 1, how much you should bring to make the stock 165? You should bring how much? 105 lakhs extra rupees, correct or not? Yes, 60 plus 105. Now you have a closing stock of 165. Yes. Now you already have a stock of 165. At the year 2, you should bring anything? No, I did not bring anything. Why? I already have 165. The closing stock will be 165. At the year end 3, should I bring in anything? No, it is already 165. I have already introduced 165 rupees worth of stock. Yes. At the end of year 4, what happens? Remember, working capital is a cycle. Amount that got invested initially will come back. It will get released at the end of the life of the project. Or in other words, here it is an investment. I need to bring this working capital at the end of year 4. This amount of 165 lakhs will be released from my system. How that it will be released? At the end of the project, what I do, whatever stock I have, I will just sell it off and I will realize cash. Correct, guys? Yes. So I invested money to have these stocks, and at the end of the period, I just sold these stock and realized money. So initially, when I brought in these stock, it was a cash outflow, and when I'm just selling it off and realizing money, it is a cash inflow. Yes or no? Always remember, till now what we have done, the only investments, the cash outflow that we have seen is our capital investment. Remember that there can also be working capital investments in the working business cycle. Are you clear with this? In the life of the project, apart from my capital expenditure investments, there can also be working capital investments. The only difference between the two is working capital investments will actually be an outflow initially and it will be an inflow at the end of the project. So if I am an examiner, I wouldn't have given this word. And the stock at the end of, okay, so I would have given this stock at the end of year 4 will be nil. Yes, I need not have given this out at all. Why? Because at the end of the project life is over. Now, what are you going to do with the stocks? You will sell it off and realize money. Are you clear with this? So even if this is not given, you should know that. At the end of the life of the project, what happens is the entire value of your working capital gets released from the system. Are you clear with this? Gets released from your cycle, gets released from your project. Are you clear with this? So with respect to working capital inventory, I will say at T0 outflow 60 lakhs, T1 end of year 1 105 lakh, 2, 3 nil, no cash outflows. At the end of year 4, I get a positive 165 lakh rupees. Are you clear with this? This is not a cost because material related cost is already taken into account here. So then this 90, 120, 255, 255 and all, what is this, sir? Apart from the stocks, they themselves have given, they have not given material purchased, they have given material consumed. So basically they have purchased and consumed 90 in year 1, 120 in year 2, 255 in year 3, and 255 in year 4. Purchase, consume, purchase, consume. That has been done parallelly. Apart from that, they are maintaining the stocks. Are you clear with this? That is the understanding that you need to make. Are you clear with this? Then the storage of material will utilize the space which would otherwise be rented out for 30 lakh rupees per annum. The second one, what they are saying, suppose I wish to process this waste and convert it into a marketable product. What I'm doing is, look, if I'm not converting this waste and all into a marketable product, then this place would have been empty, correct? And I could have rented it out and generated 30 lakh rupees per annum of what? Rent receipts. But because now I'm going to use this place for keeping my equipments and convert the waste into a marketable product, I will lose this 30 lakh rupees of rental value, correct or not? So in other words, for the purpose of my decision making, is this 30 lakhs relevant? Yes. This 30 lakhs will be treated as an outflow. Sir, how is it an outflow? Basically, sacrifice of inflow is nothing but an outflow only. I would have got this 30 lakhs because I'm going for this project. I am losing 30 lakhs, so it's going to be a negative 30 lakhs. Are you clear with this? Then labor cost will include the wages of 40 workers whose transfer to this project process will reduce the idle time payments of 45 lakhs in year 1, 30 lakhs in year 2. So what they are saying, there are already some workers in the factory who are idle. If not for this project, they would have remained idle and we would have paid some money. Fine. But since we have this process, we are saving some idle time cost of 45 lakhs in year 1, 30 lakhs in year 2. Basically, these are cash inflows. That is, I am able to save 45 lakhs in year 1 and 30 lakhs in year 4. Or in other words, reduction of cash flow is same as what? Your increase in cash inflow, correct? Reduction of outflow is equal to your increase in your inflow. Yes or no? This is a reduction of outflow, or I can even say that this is my cash inflow. It's a positive for me. Next, factory overheads include apportionment of general factory overheads except to the extent of insurance charges of 90 lakhs rupees per year payable on this venture. Now, what is the meaning of this? This is another point where students make mistake. Factory overheads includes apportionment of general factory overheads. What do you mean by apportionment? This is actually a costing area wherein, see, factory overheads, what we do, in this factory, there will be so many projects, project 1, project 2, project 3, 4, and so on, right? There is a common area, and for this common area, there is a cost incurred. What they do is, this common cost, they will apportion it between the projects and say, these projects, I'm giving a share of so much amount of the common cost. Now you tell me whether I run this particular project or not, I cannot save this common cost, correct or not? That is what they are saying here. Factory overheads, these figures 165, 180, 330 and 435 and all, this is share of a common cost that is being given to this project. Now you tell me whether I run this project or not, can I save this factory overheads? No, but they are saying out of these figures that they have given, what is relevant to this project is only to the extent of 90 lakhs. Factory overheads includes apportionment of general factory overheads. It is only general except to the extent of insurance charges of 90 lakhs payable on this venture. Or in other words, this factory overheads, all these figures you can just ignore. Why? These figures are directly coming from my apportionment. That is, whether or not I have this project, anyways, it will continue to be there. The only factory overheads relevant is 90 lakhs every year. Why? Because that is only dependent on the decision of this project. Suppose if I don't have this project, this 90 lakhs alone I can save. If I don't have this project, I will continue to be incurring all this extra cost. Are you clear? So they are saying this 165 includes 90. So technically 90 rupees is the relevant cost for this concept, for this project. The extra 75 is nothing but a share of common factory cost that is getting apportioned to this particular project. Are you clear with this? So all the common costs you need not consider, you ignore it. You take up only the relevant cost that impacts your project. Consider the cost of capital at the rate of 14%. So they have mentioned the discount rate, right? The present value factors are given for 4 years. So they have given the present value table. Advise the management on the desirability of installing the machine for processing the waste. All the calculations should form part of your answer. So now pause this video, read the entire question and then digest the facts. Now let's get into the solution of this particular question. So now first, let us calculate the statement of operating profit from processing the waste. Now, if I decided to process the waste, what will be the operating profit, year-wise operating profit? Now, year-wise, the sales figures are given 966, 966, 1254, 1254. Correct? So, copy paste the figure. These figures are given. Correct? So, this is your sales revenue that you will be making. Then, minus material consumption cost. How much is this? This figure is also given. So, this figure is given. This is also given as how much? 90, 120, 255, 255. Correct, guys? 90, 120, 255, 255. Yes. Wages. Year-wise wage cost is given 225, 225, 255, 300. Yes. Now, wait. There is an adjustment in this wages. Look at this. The labor cost includes the wages of 40 workers whose transfer to this process will reduce the idle time payments of 45 lakhs and in year 1 and 30 lakhs in year 2. So year 1's labor cost will be 225 minus 45 savings. The net amount will be how much? 180 only. Are you clear with this? 180. In year 2, how much will it be? Year 2's labor cost will be 225 rupees minus 30. How much is that? 195 rupees. This is going to be 195. Year 2 and year 3, there are no idle cost savings and all. So whatever is the data given, you can use it. Are you clear with this? So this is nothing but given data minus savings in idle time cost. Are you clear with this? Savings in idle time cost. Are you clear with this? Yes. Other expenses data is given as such 120, 135, 162, 210. So you can just plug these figures. This data is also given in the question. Then factory overheads, very important. Put an important symbol here. What is the relevant factory overheads out of whatever is a figure they have given? The only figure that is avoidable because of this decision is how much? The insurance expense only. Are you clear with this? You should only consider, we are not calculating profits for reporting purposes. We are calculating the profits that are relevant for the decision making. Remember that. So 90, 90, 90 and 90 respectively. Here we are not preparing the financial statements and reporting the exact profits. For that you will consider everything. We are talking about decision making. If I take the decision of running this machine and processing the waste, the only extra cost that I will be incurring because of my decision is the insurance cost, because all the other costs are general expenses being apportioned to this project. That's all. It cannot be saved just because of this particular decision. That is the meaning. One more thing is there. What is this? Loss of rent on storage. Clear. Opportunity cost. What is this? Because I am going for this decision, now in this place I will be placing all my equipments and I will be doing the process. Had I not taken this decision, then this place would have been empty, which I could have rented out for 30 lakhs per annum. So now I'm going to lose that 30 lakhs per annum. So this is also my cash outflow. Correct? So 30 lakhs is also considered. Look at this, guys. So this is the sales revenue, right? Here we are computing all the costs here. Correct? And we are totaling it here. Are you clear with this? The costs are being totaled here. So don't worry about this. So this is also a cost. Every year I lose how much? 30 lakhs. So losing money or reduction in cash inflow is treated as a cash outflow. Correct? Then depreciation as per income tax rules 150, 114, 84 and 63. This data is given in the question. Clear with this, guys? Yes. Now, what is the total cost? You have the figures, you add it up, you add up all the costs, you get the respective figures. So what is the profit? What is the profit that I generate because of this particular decision? If I use this factory facility for processing the waste and converting it into a marketable product, the extra profit that I will be getting is sales minus total cost. So it is 306, 8282, 378 and 306. Are you clear with this? Less tax at the rate of 30%. We have got the profit after tax of these figures. Are you clear with this? These are some calculation driven thing. So just apply this 30% on the respective profit before tax. You will arrive at the tax. So now your profit before tax minus tax gives you profit after tax. Wait, we have not computed cash flow after tax. We have just computed the profit after tax. Look, there is a way in which you can do this sum using something called as incremental cash flow model. I will explain that to you. Clear with this, guys? Yes. Till now, are you able to clear with this? That is, if I go for processing the waste and converting it into a marketable product, because of this alone, because of my business decision, I am generating an extra profit after tax of 214.2, 197.4, 264.6 and 214.2. Are you clear with this? Yes. Now see what they have done. Now see what they have done. Statement of incremental cash flows. What do you mean by incremental cash flows? Extra cash flow. Extra means what? You need to compare between two alternatives. Yes, processing the waste as compared to disposing the waste. So because I am going to process the waste, how much is the extra cash flows generating at every year as compared to my disposing of decision? So because I'm going to process now, overall, what is going to be my incremental cash flows? Cash flows can be cash inflow as well as cash outflow. First, what is the year 0, year 1, 2, 3 and 4? Now, because I'm going to process now using a machine, first at the T0 itself, today itself, what is going to be my first cash outflow? Cost of machine. How much is the value? 600 lakhs. Are you clear with this? Will I be incurring this cost of machine anytime else? No. Nil for the all the remaining years. Then material stock. This is not a cost. This is a working capital investment. Working capital investment means what? It is an outflow initially and it will be an inflow at the end of the life of the project. Sir, what is the calculation? This is what I said. At T0, it's going to be 60 lakhs. T1 is going to be 105 lakhs and 2 and 3 is going to be nil, and at the end of year 4 it's going to be 165 lakhs. Are you clear with this, guys? So this is a stock policy, minus 60 minus 105 and plus 165. Why is this? Initially itself I'm bringing a stock of 60 lakhs. At the end of year 1 I should maintain stock worth 165 lakhs. I have already have a stock of 60, so the difference between that is 165. Now I have made my stock balance as 165, so that stock should only be maintained for the next 2 years, and at the end of 4 years, the fourth year, the entire stock will get released. So this is going to be 165 positive. Guys, get this clarity. This is an important thing. Basically, this and your factory overheads, these two are very, very important adjustments that generally students miss out. Then. Now, one more thing is very important. Now, if I want to process this particular waste and convert it into a marketable product, now what I need to do is what? I also need to pay the compensation for cancelling the contract. Correct, guys? How much you need to pay? 90 lakhs at the beginning itself. Correct? They have said if you want to go for this process, what you need to do is currently you have some contractual obligation. So you need to cancel that contract, and that contract they have given what? They have given the contract can be terminated upon payment of 90 lakhs. This is what they have given. Correct? What does the contract say? Every year you need to pay 150 lakhs if you are using our services. Correct? Now, if you are going to process and not dispose, you want to terminate the services. They are saying, okay, so since you are terminating our services, pay us a penalty of 90 lakh rupees. It's a compensation. That's all. Every year you need not pay me 150 lakhs and all. We are not going to provide any service. But since you have agreed and now you are cancelling the contract, pay us 90 lakh rupees. That's what they are saying. Are you clear with this, guys? Are you clear with this? Yes. So now look at this. Look at this. The compensation for contract is going to be how much? 90 lakhs. But wait, because you're paying this 90 lakhs, from now on, you are going to save 150 lakhs. Yes or no? So contract payment saved initially 0. At the end of every year, it's going to be plus 150 lakhs. Are you clear with this? Sir, why are we doing all this? We are comparing how much extra cash flow we are able to generate if we process and not dispose of. So how much extra, how will you compute when you compare the relevant cash flows as compared to the two alternatives of processing and disposal? So if I process, I will be incurring 90 lakhs, which is going to be a negative, but I will be saving 150 lakhs every year. That is going to be a positive. Guys, are you clear with this? Since you are comparing the two cash flows parallelly, it's called as incremental cash flow approach. Then now what happens here? Every year you are now doing what? You are now saving for 150 lakhs. Correct? On this 150 lakhs, till date, this 150 lakhs was a tax deductible expense. Yes or no? This 90 lakhs is not allowed for tax purpose, they told, but this 150 lakhs was a tax deductible expense whenever I was paying. Since I am not paying that 150 lakhs right now, I am saving 150 lakhs, but I am losing out on the benefit of 150 tax benefit on this 150 lakhs. Or in other words, on this 150 lakhs, I am also losing out the tax benefit. Till date, I was paying 150 lakhs. It was an expense for me. When this was an expense, I was also paying lesser tax. Now, since I am not paying this 150 lakhs as an expense, I incremented it and I considered it as a cash inflow. Correct? Now, what happens parallelly? Now the tax benefit on that is also something that I'm losing. So I need to reduce that. So that is going to be 45 lakhs every year. That is, what is the percentage of tax? It's 30% on 150 lakhs is going to be 45 lakhs. So every year, I save the contract payment, but I lose the tax benefit. Net of, if you see, technically, the net amount of contract payment saved post-tax is only 105. If you want, you can directly put 105 and give the calculation. That is also fine. Yes. So now you tell me, what is the incremental profit? If I go for this particular project, every year, what is the incremental profit that I earn? 306, 282, 378, and 306. Correct? You fill these figures here. This figures is nothing but the figure C that we calculated above. Are you clear with this? Fine. So these are all some relevant cash flows. Then this C is nothing but the exclusive cash flow that we are able to generate from this processing. Now, in this 306 or in this particular calculation, we have considered depreciation. Correct, guys? Yes. So add back the depreciation. Why? Because depreciation is not a cash outflow. So you add back the depreciation, respective year's depreciation, you add it back. Correct? But you should subtract the tax on profits. Correct? The tax on profits for the respective year, 91.8, 84.6, 113.4, and 91.8. These four profits you just subtract. That is, this is cash flow. This is actually profit before tax and depreciation. Sorry, this is profit before tax. Correct? This is the line item here that we have got. Profit before tax. Add back depreciation and reduce your taxes. You get what? Net cash flows after tax. You get your net cash flows after tax. Now, one more thing that we need to consider here is what? Now, at the end of the life of the project, what happens is we are able to sell this machine. Correct? How much you are able to sell this machine for? They had given the data. What is it that they had given? 60 lakhs is the value at which they have sold. Yes, but wait. For you to sell this, you should incur some dismantling cost of 45 lakhs. So 60 minus 45 gives you 15. The net cost is going to be how much? Only. So the net cash inflow is only going to be 15 lakhs. Are you clear with this? So here we will say the profit on sale. Technically, it should not be called as a profit. I will say net proceeds on sale of machinery, but institute has used this language, so let's also follow it. It's going to be 15. How we got this 15? 60 minus 45. Are you clear with this? So these are the relevant cash flows. So the total incremental cash flows after tax, year 1, this is year 0, 1, 2, 3 and 4. So year wise you have the relevant cash flows. Present value interest factor you can use at whatever is the discount rate mentioned in the question, 14%. You can just copy paste these discount rate, but for the first year 0 alone, be very careful. Year 0 is already in present value, it's in 1. So the discount rate should start from year 1. So it's going to be at the rate of 14%. You apply this. The relevant cash flows multiplied with the present value interest factor gives you what? The present value of cash flows. So you get the every year's present value of cash flows. So your net inflow, your present value of inflow minus your present value of outflow gives you the net present value. And if you do this in this question, you are getting a net present value of positive 528.16. Since the NPV of the cash flows is 528.6, which is positive, the management should go for installing the new machine. Are you clear with this? So what all we did here, we considered every single line item. Yes, first we calculated the operating profit generated from processing of waste. Then we computed the incremental cash flows. What do you mean by incremental cash flow? Because I'm going for processing of this particular waste. So what happens? I need to spend extra on my machine. Yes, which is an outflow. Correct. Then there is some working capital changes and all. Yes, I need to introduce some working capital amount which gets released at the end of the period. Compensation for contract payment. Then what happens? I save every year. Annually, I save some annual contract payment, but on that I lose out on the tax benefit that needs to be considered. The incremental profit I have by comparing the two, but plus extra incremental profit, how much I generate year wise, we have the figure. Add back the depreciation, less your taxes, you get your what? And of course finally you get your you should add your residual value also, the net sale proceeds by sale of machinery. All these the relevant cash flows. You get your incremental cash flows after tax, and multiplied with the relevant present value interest factors, you get the present value cash flows, and you sum total all the present value cash flows, you get your NPV. And since your NPV is positive, you can go for this particular project. Are you clear with this? Look at the notes that they have given. Material stock increases are taken in cash flow. This is what I explained. Idle time wages have also been considered. This is also explained. Apportioned factory overheads are not relevant and only the insurance charges of this project are relevant. This has also been explained. Sale of machinery, net income after deducting removable expenses are taken, and tax on capital gains has been ignored. This has also been considered. And then savings in contract payment and income tax thereon is considered in the cash flows. So all these are notes that they have given. This is a study material sum, and I'm expecting this kind of question in exams. Please guys, please follow this question, and I would suggest just mark this question as important category question, because see, this could be a full-fledged 10-mark question, and in case they are testing you on this particular area, it's a beautiful question. Now you tell me guys, in this question, is there anything new that I taught apart from the working capital? I accept, because working capital is chapter that we are going to see next. Apart from that, is there anything new that I have taught you? Everything else was something that we've already seen. The problem was only interpreting the question and applying it accordingly. That was the only problem. I understand. So if you patiently read the question, you will be able to understand this and do this question by yourself. The decision is what? Whether to process and sell the waste, or is it better to dispose of? We found out the incremental cash flows, and since the incremental NPV was positive, we said go ahead with processing the waste and selling it. In case the incremental NPV came out to be negative, we will say no, then you better continue with disposing of itself. This is not a viable project. Are you able to understand this investment decision? Where I should invest my funds, whether it's worthwhile investing these funds in a machinery and converting my waste into a marketable product and selling, or disposing of my waste itself as such. So this is an investment decision that we are doing on the asset side. Should I make this investment? Is it worthwhile making the investment on my equipment or machinery or not? Are you clear with this? And that's about the sum. Please mark this as important. Are you clear with this? So now let's quickly go to the next question. The next question is equally important, guys. Next question is equally important. So please mark this sum also as important, because in marathon, I'm covering the typical examination related problems as well. So case study questions. This is about capital budgeting in replacement decision. So what it is, we will see. HMR Limited is considering replacing a manually operated old machine with a fully automatic new machine, right? So currently what they have, some old machine they have, which is manually operated. They want to purchase what? Fully automatic new machines. The old machine has been fully depreciated for tax purpose, but has a book value of 2,40,000 on 31st of March 2021, right? This is given. The machine has begun causing problems with breakdowns, and it cannot fetch more than 30,000 rupees if it is sold in the market at present. So today, if I want to dispose of the old machine, I will not get beyond 30,000 rupees. That's what they are saying. It will have no realizable value after 10 years. Suppose I am not I don't want to dispose of, some emotional reason, I want to continue using this old machine for 10 years. At the end of 10 years, it will not even have this 30,000 rupees of value. It will have zero value only, right? The company has been offered rupees 1 lakh for the old machine as a trade-in on a new machine, which has a price before allowance of trade-in of 4,50,000. What they are saying. Now, let's say you are going to a big company, right? Let's say you are going to purchase a new machinery. Now, what these guys are saying is, look, we are allowing you for an exchange offer. Now, exchange, now you would have seen in your mobile phones, correct? If you want to buy a new mobile phone, in this example, if you want to buy a new machinery, it will cost how much? 4.5 lakhs. But if you are willing to exchange your old machinery, we will take that old machinery for 1 lakh rupees. It is enough if you pay me 3.5 lakh rupees. This is the meaning of this. Are you clear with this? Fine. So technically, if you sell this machinery, let's say you have an old phone, correct? In this example, I'm just taking. If you sell that old phone in OLX or open market, second-hand market, you will get only 30,000 rupees, correct? But if you exchange it with Flipkart for a new phone, they are ready to actually exchange it by paying you 1 lakh rupees. Are you clear with this? This is the meaning. This is the context that is given in the question, right? Technically, in Flipkart and all, it works other way around. If you sell it in the second-hand market, you get more money, while Flipkart doesn't pay much for all these exchanges. But anyways, right? Coming back to the discussion. The expected life of the new machine is 10 years and the salvage value is 35,000. The new machine, if you purchase it today, 4.5 lakhs minus 1 lakh, net investment is 3.5 lakhs that you need to pay. But wait, you can use it for 10 years, and at the end of 10th year, what will happen? 35,000 rupees salvage value also you have. Further, the company follows straight line method of depreciation, but for income tax purpose, return down value of method of depreciation at the rate of 7.5% is allowed, taking that this is the only machine in the block of assets. So for books, for the purpose of accounts, they have taken into account SLM, whereas income tax, what is allowed is WDV. So what we now need to do, we need to reverse this SLM, compute WDV method of depreciation. Based on that, you need to compute the tax and once again add back the depreciation. This is what we need to do. Given below are the expected sales and costs from both old and new machine. Now, old and new machine, using the old machine or the new machine for the next 10 years, every year I can generate 8,10,000 rupees of sales, whether I use old or new. That is not a problem. The problem comes on the cost side. Look at this. If I use the old machine, material cost is 1,80,000. Whereas if I use the new machine, the material cost is only 1,26,250. Why? Because the new machine is more efficient. Correct? So it requires a lesser consumption, there is lesser wastage in my new machine. Next, labor cost 135 in old machine, new machine only 110. Why? Because this is actually this is your manual machine, whereas new machine is only automated, so lesser wastage cost, lesser labor cost. Then variable overhead is also lesser. The variable overhead is 56,250 for old machine, whereas just 47,500 for the new machine. These are the required data given, and of course fixed overheads respective figures, depreciation respective figures, profit before tax is given, tax has been given, and then your profit after tax for each of the two alternatives have been given. Now, from the above information, analyze whether the old machine should be replaced or not if the required rate of return is 10%. What do you mean by required rate of return? Your KO, the weighted average cost of capital. Ignore the capital gains tax. So basically what they are saying, look, currently we have a machine, old machine we have, and this machine, it doesn't have, we have already, it is already there in our books, correct? Today, should I pay anything to buy it? No, I already have it. Are you clear with this? Yes. So if I continue with this for the next 10 years, yes, so this is the sales and cost data given in the question. No. If I purchase a new machine, what happens? The initial cash outflow and year-wise sales and cost is given. Apart from that, you also have something called as a salvage value for the new machine. Then depreciation is also given. The question is, should the old machine be continued or you should replace the old machine with a new machine? That is why we call it as replacement decision. Are you clear with this? Very simple, guys. Pause this video for a while. Just go through the facts of the question and then let's get started with the discussion. Now, look at this. Workings. The first one is calculation for the base for depreciation or the cost of the new machine. New machine, what is the purchase price? 4,50,000. But wait, if I am buying the new machine, obviously I will discard my old machine, correct? So I can exchange it with him. He is ready to take it for 1 lakh rupees. So my net cost, if I buy the new machine, is only going to be 3,50,000. So at the beginning of T0, if I am going for the new machine, I need to shell out extra cash of how much? 3,50,000, right? Now, look at this. Profit before tax as per books. Profit before tax as per books. Now, look at this. Old machine, new machine, difference. 3 columns we are having. Now, profit before tax as per books. Where is the data given? So, they have given profit before tax 324,750, 387,250. Yes, guys. So 324,750, 387,250. So the difference between the profit before tax is how much? 62,500. Or in other words, if I go for this new machine, the extra profit before tax that I will be getting every year is how much? 62,500 rupees. Correct? Add back depreciation as per books. This depreciation, we don't need it. Why? Because it is under SLM method. Depreciation as per books. So 24,000 and 41,500. Add back these depreciation. So 24,000, 41,500. You add it back. You get how much? 17,500 is the difference. Then profit before depreciation and tax. So if you add it back, so old machine gives you a profit before depreciation and tax. How much is this? 3,48,750. New machine gives how much? 4,28,750. So the overall extra profit before tax and depreciation, if you use the new machine, will be how much? 80,000 rupees. Remember, if I use the new machine, the extra profit it generates before considering my income tax and depreciation is going to be 80,000. This is the meaning. Are you clear with this? Or in other words, every year, I will be able to generate 80,000 rupees of extra profit without considering my income tax and depreciation. Guys, are you clear with this? This is not cash flow. This is just a profit. So we need to compute the incremental cash flows right now. Since we are comparing two alternatives, we can directly compute the incremental cash flows. Are you clear with this? Calculation of incremental NPV. Now, what is the life of this particular asset? 10 years, correct? So 1 to 10 year wise, you put this data. The present value interest factor for 10 years, this comes in the first column. Are you clear with this? Now, every year, the starting point is what? Every year, what is the incremental profit before tax and depreciation? What is the extra? What is the extra profit before tax and depreciation that I will be earning if I go for the new machine as compared to the old machine? 80,000 rupees every year I will be earning extra. Yes or no? Now this earnings, this profit is what? Before tax, before depreciation. In this method, some SLM method of depreciation was given. We added it back. So this is actually profit, extra profit before tax and depreciation. Are you clear with this? So now we need to reduce the depreciation, but this depreciation should be as per what method? As per WDV method. Yes or no? Now, guys, 1 minute. Now you tell me, they have given it very clearly in the question. They have given it very clearly in the question. Look at this. So somewhere they had given that this, yes. Look at this. The old machine has been fully depreciated for the tax purpose, which means from the perspective of income tax, if you're continuing with the old machine, will you have any depreciation? No. If there is no depreciation, will you have any tax savings on depreciation? No. That is this old asset got fully depreciated from the viewpoint of income tax. So there is no tax shield or there is no depreciation if you go for the continue with the old machine. If you go with the new machine, what they are saying, they are willing to provide you 7.5% under WDV method. WDV means what? Return down value method. So which means every year the extra depreciation will be only coming out of the new machine. Are you clear with this? Or in other words, if I go for this new machinery, whatever is the depreciation on the new machinery, that itself is the incremental depreciation. So this incremental depreciation means what? See, this is the incremental profit that I will be generating if I go for the new machine as compared to the old machine. Correct? Yes. This should also be incremental depreciation if I go for the new machine as compared to the old machine. Correct. Now, old machine, what will be the depreciation if I'm continuing for the next 10 years? 0. Correct. So what will be the depreciation for the new machine? 7.5% per annum. For what? For on WDV method. Correct or not? So technically the extra depreciation that will be happening, that I will be incurring every year because of this decision, will actually be nothing but your 7.5% on WDV minus 0. Why minus 0? Because under the old machine, it's fully depreciated, no depreciation at all. So basically, the extra depreciation that I need to compute is nothing but the depreciation on the new machine. But remember, this depreciation on the new machine should be under WDV method. So now, how will you compute this? Guys, in this question, in study material, they have not given you the manner. I mean, they have not given you the working note for calculating this depreciation. So quickly, I will just take an Excel file and I will just compute it. I will just show you how to do this. So now, right? So now you tell me what is the value of this particular machine. So we are just going to compute what? We are just going to compute the depreciation. We are just going to compute the depreciation under WDV method. So we are just going to compute the depreciation under WDV method. So now look at this. So now let's take this as the opening balance. This is depreciation at the rate of 7.5% on opening balance. Correct? So this is going to be your closing balance. Yes. Fine. Are you clear with this? Yes. So now year 1, 2, 3, 4, 5, 6, and so on. Next 10 years, you got, yes, so the next 10 years. Opening balance. What is the base on which depreciation is calculated? We calculated 3,50,000 rupees. Correct, guys? Yes. So depreciation for the first year is going to be what? Equal to 7.5% into the opening balance. Correct, guys? It's going to be how much? 26,250. Yes or no? It's going to be 26,250. Right? Fine. So now it's going to be 26,250. Now just a minute. So I'm putting all these things in figures, right? So now what is going to be your closing balance? That is your closing WDV. So I will put this as opening WDV and I will put this as closing WDV, right? Okay. So now look at this. What is going to be your closing WDV? Opening WDV minus depreciation for the year. This is going to be your closing WDV, guys. Yes or no? Then the second years, in the second year, what will be your opening WDV? It is going to be the closing WDV of the previous year. Yes, guys, correct. And what is going to be the depreciation for year 2? It is nothing but 7.5% of the second year's opening WDV. Yes, guys. Yes. So what is going to be the closing WDV for year 2? It's going to be opening WDV minus the depreciation on the opening WDV. That is opening WDV minus depreciation. So here you have what? F4 minus G4. That is this 723,750 minus 24,821.25. This is going to be a closing WDV. So this calculation you need to do for how much? 10 years. Now in Excel, if you do automatically, you can just get these figures. So, but in exam, you don't have this luxury. What you need to do every year, you need to compute the WDV. So the WDV is going to be this. The WDV, year-wise WDV is going to be 26,250, 24,281.25, 22,460.16 and so on. This is exactly what they have done here in this question. Look at this. 26,250, correct? Then 24,281.25. 24,281.25. Directly go to 7th year. See 16,442.95. See 16,442.95. Can I see this figures? Last year 13,013.82. 13,013.82. Ideally speaking, if you ask me, this should come by way of a working note. This should ideally come by way of a working note. In my opinion, this should come by way of a working note. In exam, you don't have all this facility of using spreadsheets. This is a calculation that you need to do. Simple accounts calculation. Your WDV calculation is something that you need to do. Are you clear with this? So now, what is it that we have calculated till now? Extra profit before tax and depreciation. Now we have calculated the extra depreciation that I will be incurring every year because of what? Because of depreciation. Correct? Yes, I mean because of going for the new machine. Now, what is the profit before tax? Profit before tax, that is the incremental profit before tax. That is profit before tax and depreciation minus depreciation. This is the incremental profit before tax, or in other words, year wise we are computing how much extra profit before tax we are able to generate if you are going for the new machine as compared to the old machine. Are you clear with this? On this only we are computing the tax. This is nothing but the tax payable on that extra profit generated every year. So this is nothing but column number 4 into 30% tax. Are you clear with this? So what is going to be my incremental cash flows after tax? What is going to be my incremental cash flows after tax? Be very, very clear about this. Profit before tax minus tax, add back depreciation. Are you clear with this? This is the extra profit before tax I generate every year minus extra tax I pay on this extra profit. Add back the extra depreciation that was reduced to arrive at this PBT, because it's actually not a cash expense. Are you clear with this? So profit before tax, column number 4 minus tax, which is column number 5, plus the incremental depreciation, column number 3, you get the incremental cash flows after tax. Are you clear with this? So this is ideally the extra cash flow after tax that I am generating because I am going for the new machinery. Are you clear with this? So multiply the respective cash flows with your present value interest factor table. You will get the present value of cash flows, the present value of all the cash inflows. You will get how much? 3,81,102.44. Correct? wait. At the end of the life of the asset, what happens? You also have salvage value. Remember, the salvage value is there only for new machine. So in old machine, there is no salvage value. So technically, this is 35,000 minus 0. Correct? If I'm going for the new machine, I get 35,000. Old machine does not have any salvage value. So what is the extra salvage value that I get? 35,000 into 0.368. What is this 0.368? That is a discount factor for the 10th year. So this is also what a cash inflow for me. So the present value, total present value of incremental cash inflows is 3,94,612.44 minus the cost of machine. Today, how much extra I have to incur? 3,50,000. This 3,50,000 is nothing but 4.5 lakhs minus 1 lakhs. Correct? Minus 1 lakh, 3.5 lakh. So incremental net present value is going to be 44,612.44. Or in other words, if I opt and go for this new machine, if I replace my old machine with my new machine, the incremental net present value I get is 44,612 rupees 0.44. So since the incremental NPV is positive, the old machine should be replaced. Are you clear with this? Are you clear with this? That's an alternative way of doing. You compute the NPV for new machine, then separately compute the NPV for old machine, and obviously the NPV of new machine will be more than the NPV of old machine. NPV of new minus NPV of old, the difference will exactly be 44,612.44, and you can say since the NPV of new machine is more than the old machine, you can go for it. That way you can do, but this incremental cash flows is what institute expects you to do, because this solution I'm discussing it as such given in your institute study material. So this is very important. Are you clear with this? Guys, this is again a very important question. Please go through it once, solve this question by yourself. And with this, we have covered this entire chapter of capital budgeting. So basically, this sum, the fifth and sixth sum are very important sums. Please mark them as important. Even the fourth sum that I did was very important because it had all the time value of money techniques. All the capital budgeting techniques were there in this particular question. This is also a very good sum. So please mark these sums are important. It's very important. Fine. So basically, this chapter is all about how am I going to invest? Where am I going to invest the funds that I have raised from different sources of finance? Where I should invest? So how will you find out? How will you take this investment decisions? How will you take using multiple techniques? These techniques could be what? These techniques could be time value. These techniques could be traditional techniques, or it could be time adjusted techniques. Traditional techniques, payback period. What do you mean by payback period? Payback period means the time taken for me to recover back my initial investment without considering time value of money. Accounting rate of return, average profits divided by investment. The denominator investment can either be an initial investment or an average investment. NPV, profitability index, IRR, we have seen it. NPV is nothing but present value of cash inflow minus present value of cash outflow. So if the NPV is positive, go for the project, else don't go for it. Profitability index is present value of cash inflow upon present value of cash outflow. If the profitability index is 1 or more, then you can go for it. IRR is the rate that makes my NPV equal to 0. What is the decision criteria? If your IRR is greater than your weighted average cost of capital, then you can go for this particular project. And discounted payback period, what is it? It is same as payback period, but here the cash inflows are discounted using your weighted average cost of capital. So the time it takes for me to recover my discounted cash flows is called as the discounted payback period. And MIRR is a rarely tested area, which is a detailed discussion by itself. There are some limitations of IRR that gets actually compensated by this concept of MIRR. Since it's rarely tested, I just focused more on this predominant portion of this chapter, and the important facts of this particular chapter lies in this area. Especially the heart of this chapter is going to be your NPV profitability index, IRR. Basically your NPV IRR, this is the area where it's going to be important. Are you clear with this? So basically I've also given this one-page summary I have just given it here. I've just taken it from your study material. So non-discounted method, payback. Correct. So when for independent projects, for mutually exclusive project, independent projects means what? A, B, C. Let's say there are 3 projects. You can choose A, B, and C, or one or more than one project can be chosen at a time. In that case, what you will do, when payback period is less than or equal to the maximum payback period, you accept it. Now, generally, I can accept if the payback period is only 2 years. Correct? I want to recover my money in 2 years. So lesser the payback period, it is better. Are you clear with this? Mutually exclusive means what? A, B, C are 3 projects. Out of these projects, you are allowed to select only one. So the project with the least payback period you should select. Accounting rate of return, you should choose the project with the maximum accounting rate of return. NPV, what do we do? If it is greater than 0, we accept it. If it is less than 0, we reject it in case of independent projects. In case of mutually exclusive projects, that is competition is there, what you do? You choose that project with the highest positive NPV. Then profitability index greater than 1, accept, less than 1, reject. Or if it is a competing project, mutually exclusive project, choose the one that has the highest profitability index. IRR, what do you do? IRR is greater than K. K means what? Weighted average cost of capital, accepted. If it is less than K, rejected. Then the project with, in case of mutually exclusive projects, compare the IRR of multiple projects and choose the one with the maximum IRR. Are you clear with this? With this, we have revised this entire chapter thoroughly. So now let's move to the next chapter.